pretty much, the syllabus and the course outline that I set up will give you an idea of the types of things we're going to cover. I can't promise I'm going to stay in exactly that order, but I'm going to do my best, because I tend to touch on things out of order. It's a little hard for me to stay organized that way, and I'll try and get to the stuff. If you see there's a topic that you have a particular question or interest about that I don't have included in here, please let me know, and I'll see if I can throw something in or answer some questions, or we can set some time for a general discussion on a particular topic. I'm going to go through, well, all kinds of different things. And one of the things that I wanted to start with, and this is more of an overview than anything else, people don't realize that in a real estate practice, you're actually touching on a lot of other areas of law. You really have to get involved in it. And some of that is because of the fact that we do title exam work and have to determine whether or not the title to the property is good for the buyer. I'm also an agent for a title insurance underwriter, which most lawyers in Florida that do real estate transactions are. We get raw materials and then we issue an insurance policy ensuring the quality of the title. So in looking at that and looking at the things that are contained in that, you have to be able to evaluate other areas of the law that touch it, whether it's corporate, litigation, estates, all kinds of things like that. It's something I call the tentacles of real estate. It just kind of reaches out and touches everything, or everything else touches. So real estate practices are very varied. You have loan closings, where you're dealing with a bank, either for the side of representing a bank, which a lot of lawyers and large firms like to do. I find it boring because it's the same documents all the time, with some slight variation. Loan documents, it's a very profitable practice if you don't mind following the inane orders of the lender's officers who are telling you what to do, and you really have to do what they say, whether you think it's practical or not. From the other side, you're representing the borrower, which is what I prefer to do, representing individuals, businesses, some institutions where they are borrowing money either for refinancing, construction, or to acquire property. It's two sides of the same concept, but it's a very different way of practicing. There's also residential practice. Some of you said you worked in real estate or had some dealings. Of those, anybody residential brokers? Okay, so that's a particular type of practice where you're buying and selling houses. You're helping people find houses, go through the process of acquiring it or selling, dealing with inspections, dealing with loans, all kinds of different things, but it's a specific kind of practice. It's much more heavily regulated than the other kinds of practice. Grab a contract, please. It's much more heavily regulated, especially in the lending field, than commercial loans, because individuals that are buying properties need more protection because they are less sophisticated than someone that's buying a $20 million hotel or a commercial building or something like that. So commercial transactions tend to be more complicated, more sophisticated, and more interesting. They are, as you could learn in your finance, they are business transactions. They're more than just a real estate transaction. When you are looking at them, you're looking at a whole bunch of factors dealing with the transaction itself. There's land deals, which is raw land. That's kind of simple, but there's got to be a purpose for it. They have to be usable for things. Income property, buying something primarily for the income stream. I'm sure you're touching on that. Well, you're just starting today, right? In the finance course?
Yes.
Okay, so when you're looking at income property, the value of the property, this is pretty basic, the value of the property is in part determined by the income it's throwing off. Obviously, the rate of return, you've got to look at the expenses, all the things that are necessary to determine is it a good investment or not. That's a factor. Another factor, we'll talk about appraisals and how they work a little bit later on, of course, but another factor is how does that piece of property compare to another piece of property that's similar? That's called the comparative sales approach. And the third factor is if something happens to this property, how much does it cost to replace it? Replacement cost. Those are the three factors that go into an appraisal. So within income property, you have different categories and classifications. You have offices, you have industrial, like a warehouse, a manufacturing facility, and retail, shopping centers, things like that. There's also residential income property, which is different than typical residential real estate because it gets into apartment houses, condominiums, which is a development situation. We'll talk about all the various things. I'm just trying to stay with an overview. Other things in a real estate practice, landlord-tenant practice. Well, there's a couple of aspects to that. There's your basic representing landlords and tenants in things like evictions, but more importantly, there's leasing, writing and reviewing leases. Residential leases, not so much, because for the most part, people use a mandated form, fill in the blanks form, and I rarely get involved in that. The Florida Association of Realtors, the Florida Supreme Court, they've approved a form that works pretty well for most residential tenancies, and I would imagine that at least half the people in this room, if you're living somewhere other than the home that you own or with your parents, that you've signed one of these leases. They've done things with made very easy, blanks to fill in, boxes to check so that you don't make mistakes, and it pretty much governs most of the stuff. And the best thing that they've done over the past several years in that form is they put in what's called a liquidated damages provision. Instead of the landlord coming and suing a tenant, and let's face it, somebody that's typically renting a residence is not going to be a wealthier person. They're going to be somebody, could be a student, could be somebody who's just starting working, and the landlord really doesn't want to go and sue them and go chase them and try and collect. So the tenant agrees that if they break the lease, default into the lease. I tried to explain to people years ago, leases are not made of glass, you cannot break them. But if you cancel the lease, terminate early, you have a penalty clause, damages that you agreed 2 months rent. And it just makes the whole process a little bit easier. Condominium law is the scourge of the earth. I'm not going to talk too much about that. That's where you take a bunch of people and put them into a building and let them fight with each other. And they're all co-owners, and each one owns their own box of the sky, but each one also owns their own undivided percentage of the building. It really is a wonderful thing. So 2 years ago, I sold my house. My wife and I moved downtown Fort Lauderdale to a high-rise condominium. And forget that I don't get involved in the condominium politics. Luckily, it's a well-run building. But the box in the sky, I will never touch another sprinkler head in my lifetime. It's lovely. And it's also 3 blocks from my office. And it's actually kind of like living in a college dorm because we've made all kinds of friends with people in the building. We go out way too much and go to each other's place for a drink and then go out to dinner. It's downtown so we can walk on Las Olas. It's really a nice lifestyle. But in terms of the legalities of a condominium and how they operate and how you live in one, not so much. Other practice in real estate is development. We'll talk about that. Development, which ties into land use. When someone is acquiring property for the purpose of building something on it, they have to make sure they have the rights to build on it. They have to know what they're going to be able to build on it, what permits they require. We'll talk about those kinds of issues as well. But these are all things that are involved in different aspects of real estate practice. Land use is zoning, permitting, site plan approvals, building permits, all types of things like that. Sounds like a fairly standard thing, but it causes a tremendous amount of controversy because, first of all, if you have a housing development, someplace you live, and somebody wants to build a factory next door, you're going to object because proper land use planning says you wouldn't put a factory next to a housing development because a factory is going to emit sounds and smells and noxious things that people at homes don't want. One of the things I'm doing, I'm representing a large client that acquired a portfolio of radio broadcasting towers around the country. And things that unless you're dealing in that stuff, you would never think about these things. Well, these are primarily not cell towers, these are broadcasting towers. So they're anywhere from 500 to 1,500 feet tall, and certain of them have guy wires that extend out horizontally to concrete anchors. I learned all kinds of things that I never had any idea. Well, when these were built, back when broadcast radio was much more prevalent than it is today, before you had satellite and things, apparently it's still popular in some places, these towers were put way out in the middle of nowhere. So, there was lots of land, so they buy a large piece of land, put the tower, spread out all the support equipment, build a building that housed the the electronics they needed to do this, and that was it. Well, way out in the middle of nowhere, suddenly became closer in and closer in as cities developed and grew out in the direction of nowhere. I can tell you stories about here, you know, this whole area was the middle of nowhere. I mean, this whole campus area that's all of Nova and BCC and every other building and the high school, this was all an airport once upon a time. And it was a private airport, and was eventually donated to the schools for educational purposes. So, you know, this was, I had older guys that I worked with when I was a younger lawyer who said, west of 441 was the end of the world. There was nothing out there. So it changes. The development grows out in what was in the middle of nowhere. Anyway, so what's happened with these properties is now they have all this excess land around these towers, and they're working to sell it off. The problem is, the towers, depending on what the AM towers particularly, emit radiation. So you have to be very careful as to who you're selling to, and that the people know, you know, okay, it's possible that if your builders use cheap equipment, at night when the signal power goes up, we may be opening and closing your garage doors. So it's stuff you have to think about, you have to warn, all kinds of interesting things. So that's some of the land use and some of the development issues. And again, I'll try and get into more detail as we go through the course. The other thing that comes up in my practice and in any commercial real estate practice, you have to deal with entities, corporations, partnerships, limited liability companies. You have to deal with existence issues, make sure they exist. You have to find out who owns it, who has the authority to deal with it, who can sell it, who can finance it, who can speak for the company, who can sign for the company. There's all kinds of issues involved with that, especially when you're dealing with a sale or conveyance, because there's different rules if a company has lots of different properties and it's their business to buy and sell, or if it's like the last asset of the company and they're liquidating and winding up. Different rules and requirements, but you got to know it. It's not something that you could just say, oh, we have a corporate department over here. That's great in terms of writing agreements and things like that. But in terms of knowing what the law is and understanding when you're examining title and knowing who's buying and selling, you have to know something about corporate law, limited liability law, etc. Probate. This is more, probate is dealing with estates. People die, property gets transferred to their families. There's a process. There's a court process, or maybe it's done in a trust. This more comes up in residential transactions than it does, bless you, than it does in commercial, because for the most part, in commercial, people are holding title in entities, and you don't see the issues that come up with estate planning or estate proceedings as you would with a house. But same issues in terms of authority, how the person get the right to do anything with the property, either court orders, things of that nature. Trusts, very popular thing to do is for people as they get later on in life to put their properties into a trust as opposed to holding it in their own name, including their residences and other properties. Some people hold their commercial property that way because having it in a trust will avoid probate. So the family doesn't want to have to go through the court proceedings and the complications that go with that, and of course the expense, because nobody wants to really pay a lawyer. So you have to examine the trust, you have to show their authority, make sure that the people that are selling have the right. And then of course, it's not always the case that the law follows what the documents say. There are some certain rules to protect the families. Florida has a law called homestead. And homestead protects the primary residence of people. You may have heard of the homestead tax exemption if any of you own a home. That carries with it a couple of different benefits. The homestead is actually three different things. In law, they call it the legal chameleon. The homestead tax exemption is financial. It's a taxing thing. Number one, you get a break, small break on your assessment. More importantly, there is a cap on the annual increases in assessments each year for your homestead. It's called the Save Our Homes exemption. So it can't go up more than 3% or cost of living, whichever is less, in a given year until you sell it. Homestead is also exempt from forced sale. And I'm going to go through all, I'm just trying to do an overview here. Of course, sure, question.
Okay. When you have homestead, you said your homestead, it's against forced sale. How about forced sale by IRS debt?
Or anything else? What?
Well, no, wait. That's federal. IRS trumps state law, unfortunately.
So tax deed, foreclosure?
Wait, tax deed is state law.
But
A foreclosure, you can't foreclose on a homestead. We're going to get, I'm happy to answer questions, happy to. But I'm going to tell you, I'm going to get into heavier detail on this when we start dealing with title. But I want to do it, I'll answer both questions. So, an exemption from forced sale, means that if you owe somebody money, take a credit card for example, you don't pay the credit card, and the credit card company goes out and they go to court and they sue and they get a judgment against the person. The way you enforce a judgment is you find an asset, whether it's a car or jewelry or a piece of real estate, and you execute on the judgment. You have the sheriff, it's literally the sheriff holds a public sale, sells the property for whatever the highest bidder will pay, and the money is used to satisfy the debt. Homestead, which is your primary residence in Florida, is exempt from that process with a few exceptions. One of the exceptions, you mentioned foreclosure, but foreclosure typically implies a mortgage, and a mortgage is a consensual lien. That is where the owner of the homestead goes and signs their name on the piece of paper and says, yes, I agree to put this lien on my property. The other exemption, or the other exception to that is if you're having work done to the homestead. So that you can't bring somebody in and put a new roof on your house and not pay them and be exempt. That doesn't work either. But on other kinds of debts, and unfortunately the IRS has a superior lien because they're federal. And there's something called supremacy. Federal trumps state law.
what is that sale called for a judgment when they sell assets? What is that?
An execution sale.
Execution sale.
You're executing on the judgment. You're actually taking, and exactly, you can actually go to, well, depends on whether it's real estate, or actually it's a sheriff's sale or a foreclosure. Most, now the foreclosures are all online, and you can watch them take place, just log on and watch them, which has been a little bit of a problem in the practice area because people will just think they can bid small amounts of money and it drives the price up unnecessarily. But then we'll talk about that when we talk about foreclosures. The other kinds of sales, like the credit card judgment, or, you agree to pay, I loan you on a note. I give you $200,000 on a note to go do something, and you agree to pay me back in a year, and you don't. So I go to court, I get a judgment, the judge says, yes, you owe me the money. So now I say, okay, I got a judgment, and you go, I'm paying you. So what do? I go find something you own, and I tell the sheriff, I write court papers, the sheriff attaches it, either with if it's movable, he physically takes possession, otherwise puts a lien on it in some way or another, and they have a sale in the lobby of the sheriff's office.
Does that pierce the corporate veil? Like
No, that's different. We'll talk, that's altogether different. Good question though. When do we get to corporations on that? Because now you're getting a little deeper. That is a good one though. Okay, back to transactions generally. I'm back to talking about the different things that get involved in a real estate practice that you have to kind of know something about. Now you just seen, I talked about executing and litigation and things like that. But I haven't got to that really. So you see all these different things that are actually involved in real estate and involved in real estate titles. Next issue is taxation. Obviously, whether or not you've had a little bit of exposure to income tax principles, you buy something and sell it for a profit, you have to pay tax. So there's ways that transactions have to be structured, either putting things on the closing statement, way you classify payments and leases, or any other way, how to terminate agreements, how to sell a business. These are all income tax considerations. In real estate, we have something that we'll talk about called a tax-deferred exchange, where you can sell a piece of property and with a little bit of maneuvering, take the money and reinvest it in new real estate and not pay your income tax yet. The key word is defer. It doesn't go away. It can never make your taxes go away. With one exception, it's quite expensive and it's called dying. Then there's state taxation, which really gets even more involved in your day-to-day real estate structuring. Florida has no income tax and no estate tax. So they got to come up with some way to run the government to pay for the things that we have. So we have property taxes, everybody do real estate taxes. There's actually personal property taxes. Forget that Nova's exempt. If this was a regular operating business and this was like I think Nova was exempt. Like all of these desks and chairs and such, that's tangible personal property. Tangible meaning you can touch it. Personal property means it's not real estate, you can pick it up and carry it away. So there's a separate tax that the county imposes on that. But when you are transferring property, there is a documentary stamp tax. It's called an excise tax. You might hear it called a transfer tax. And it's imposed upon the value of the property at the time that you are recording a deed. At the rate of, it's technically 70 cents per hundred. Most people say $7 a thousand. But if you do a little quick math, when you're talking about something like a $10 million transaction, you're talking about a lot of money. My decimals are right, I think that's 700,000. I think. So there's all kinds of rules involved in how to get around. Sure.
For the 1031, theoretically, you can defer your taxes until you die.
Yes. You just have to keep buying things.
Yeah, like the big people that just keep rolling in and rolling in.
Well, right, exactly.
If they roll it and they die, does that go to their heirs? Like, what happens?
So now, up to a certain point, you know, I think the exemption for estate tax is somewhere $10, $11 million for you, that you don't have to pay tax. So when you die, your heirs get what's called a step-up in basis. As you roll the money, roll the gain in that 1031, that series of transactions. So you have a profit, and you keep selling the property with a profit, and you don't recognize the gain, and you keep rolling in and buying something else. The next time you sell, same thing. However, each time you do that, the property that you're buying, the basis of the property that you're buying, which is your tax cost for income tax purposes, is reduced by the gain you don't recognize. Simple terms. Let's say you have a property worth $100,000 that you paid $50,000 for. So you have a $50,000 gain. You do the 1031, and now you buy another property for $150,000. If you do the exchange, instead of your basis being 150 on the new, it's only 50. It's reduced by the 50, so it's only 100. It's reduced by the gain not recognized. That keeps rolling.
Well, what does that mean? That means that you can't appreciate as much?
Correct. That's the second. I was going to get to that. Good. That's the second effect. The one effect is that if you do decide to cash out and sell it, you're going to have very, very little basis and much more of a gain. The other is your depreciation is reduced, unless you improve it. So it does have...
Unless you improve it.
Well, anytime you add more to something. So let's say, in my example, you buy something for $200,000. Your basis is 150 because of the rollover. Now, you decide to put a second story on the building. All of your cost that goes into the building gets added to your basis. But it's still, but that's cash out of your pocket. The other issue that I forgot about until one of my transactions is about to close is when you refinance. This was almost a gotcha, but we managed to fix it. When you refinance one of those kinds of properties, and let's take our example again, where you buy the property for $200, your basis is reduced to $150. 3 years goes by. Market's been really strong. Now the property is worth $250, and you decide you want to take some cash out, and you go and you want to put a mortgage on it for $175. I'm using round numbers so that I can keep it straight. Any cash that you take out in excess of your basis, or in my example, the basis was $150, anything is taxable income.
Really?
Capital gains, if it's long enough, but taxable income.
I thought refi was always tax-free.
Not in excess of basis. So, I did a trade, I mean, these people bought this property, I'm in the middle of a refinancing transaction now. They refinanced it once before in 2005, I think it was. The loan is just maturing now, which is why they're doing a new loan. In 2005, they had already owned it for long enough to have a gain. So they couldn't take the money out. That was only about $7 million. So you see, real life is much more significant than the examples I'm using to keep my math straight. So what they were able to do was, again, I'm drifting a little, and we'll get into what I'm talking about. The definitions will come back better, but it's what's called a securitized financing. Anybody know what the initial CMBS means? Well, pay attention to what happened to our economy in 2007, 2008, 2009? Okay, Wall Street. It's Wall Street paper, if you will. So it's a securitized loan. With a securitized loan, one of the rules is the borrower, the entity that owns the real estate and signs the note and mortgage, cannot have any other assets because they're worried about bankruptcy. So they know, they're evaluating that you own this building, this office building, or this warehouse, whatever it is. And that, but if the same company also owns a shopping center over there, and you get into trouble with the shopping center because of mismanagement or because of the economy or because too many vacancies, and the shopping center goes into default with its loan, and you have to file bankruptcy, it's going to affect both properties and both borrowers, and they won't allow that to happen. So you wind up with what's called a single-purpose entity, an SPE in shorthand terms. And there are, not only are there rules in the loan documents, but they will go so far as to make you amend the articles of incorporation of the borrower. Sometimes they'll make you go and form a Delaware entity to hold the property. There are all kinds of rules that will impose upon you. So, why did I get off into that tangent? In that case, they had $7 million worth of loan proceeds and maybe $4 million, $4.5 million of basis. They reached an agreement with the lender at that time that they could make a loan to an affiliated company. A loan, so they weren't distributing the money to the shareholders, because that would have been the taxable event. So they took the money, they created a second company, they loaned the money to the second company so that it wasn't connected for bankruptcy purposes, so we still had a single purpose entity over here, and the second company went off and did other business. Now, fast forward to today, we have the same problem again, except because of what happened in the recession and the crisis with the Wall Street paper, they've tightened the rules and they will no longer let us do a loan. They're very strict about the single purpose entity. And this time it's $12 million because the property is, the old loan is being paid off at 7. The loan to the affiliate is still out there because they bought something in another state. But now we have $12 million of loan proceeds and still only $4 million of basis. So they said, no, we will not allow the loan. You have to do something. And I went to one of my tax wizards, and we figured something out so we'll make it work.
So what I'm noticing here, so basically some of the big players in real estate, what they'll do is they'll buy commercial properties and do some of the value add to increase the income, therefore, increasing the value of the property, and then refi that money out and then put it into another property and roll it. But they keep saying that they're not paying taxes, but according to you, they're paying taxes.
Well, it depends how much they take out. If you don't take out more, it's unusual that there would be so much more money coming out in a refi than there is in your basis. You'd have to own it a long time for there to be that kind of a spread.
Or if you're increasing the value by double.
You're going to have a problem to some extent if it's double.
The basis is the original purchase price?
Your original cost minus depreciation plus capital improvements, assuming no 1031 transaction. Basically cost. I mean, that's a whole, we could spend 3 days on basis, but this isn't the tax cost. See? The back and forth helps, right? It leads us into different things. Which makes things like homestead and dock stands boring. But hey, sales tax. Again, like I said, everybody, you live in a state with no income tax and no estate tax. So you got property tax, you got excise tax on documents, you got sales tax. Well, you guys all, anybody here that doesn't pay sales tax on something? We all know what sales tax is. You go to the cash register, you see 99 cents, and they ask you for $1.06. Leases. Rent is taxable. sales tax on rent, but there's also other things that are payable in a lease, in a commercial lease. Real estate, if it's a net lease, for example, the tenant is paying the landlord's real estate tax. The tenant is reimbursing for common area maintenance in a shopping center or office building. The tenant is reimbursing for insurance costs. All things that are the landlord's expenses that the tenant is paying because the contract says so. Because the landlord wants that rent to be net, so your return on investment is computed on a net number. Back to the finance course.
Sorry, Professor Weissman. Did anybody leave this textbook thing upstairs? Nobody? Has a bunch of real estate development work in it, right next to the food that you all ate from. All right.
Did I get rid of you already?
You did. You did. I'm back.
Good to see you.
You as well.
It was my class last year. So, all of these things that these making the lease net are really reimbursements from the tenant to the landlord for expenses of the property of the landlords. That's all additional rent, and it's all subject to sales tax. And there's ways, planning things that people.
And surtax, right?
What's that?
You have surtax.
No, the surtax is only on the dock steps. That's only on a conveyance.
We get a surtax.
Oh, that's, oh
We
yes,
get
I'm sorry.
surtax to our
Yes,
tenants.
that is also a surtax, I apologize. That's the extra penny. That's, yes. However, real estate rent is less. It's like for, I have a chart somewhere, they're actually lowering it almost every year now. So it's 7% regular sales tax, and I think the sales tax on commercial rent is 6.58.
That's 5.5% sales tax, 1% surtax.
What was this? Yeah, but what's after the decimal?
1% sales surtax.
It's 5 point,
5.5. It was 5.7 last year. It's
Okay.
5.5.
so then it's 6.5 on the commercial rent. I actually have something stuck on my wall, because each county is different,
Yeah.
so that I know, because when I'm doing
That's
leases,
just Broward.
that's just Broward, right. So Dade's got a number, Palm Beach has a number, some of the other counties don't do it, but when I'm drafting the leases, I do a rent table with the tax number, and I gotta keep checking, because they keep changing it every year. Makes it a little more difficult. Then people, let's see. Real estate taxes, I talked about homestead a little bit, the cap on assessments. They passed something many years back called portability. So if you've got a benefit because your assessments have been capped on a residential property and you move, it's a fallacy called downsizing. Downsizing theoretically is what happens when your family has got to a point where the kids are out of the house and you want to sell the big house and move to the condo and put a lot of cash in your pocket. That does not work. What happens is you sell the big house and you want to move to the condo and you have to pay more, because that's just how the market is when you're going from west to east, at least in this part of the state. So, but what does happen is, for example, we lived in our house for over 20 years. Well, over that period of time, as the value of the property increased, the Save Our Homes cap on assessments keeps your assessments from going up each year. So your real estate tax is based on an artificially low number, capped at a maximum of 3% or CPI, whichever is less. So you have a valuation difference between what you're paying taxes on and what the property is worth. What the law that they passed to enable you to move without getting murdered that way is you can take that differential with you. So when you buy a new place, you file the portability documents with the county, and they lower your real estate taxes on the new property by the amount of this differential that you're taking from the old, basically porting it from one to the other.
Like the same amount?
So,
The same amount of difference. The difference.
what's the difference based on? So, say for instance, you purchased a house in '85. Now you sold it, purchased it for $80,000 back then. So they've been assessing it at $30,000, $40,000, right?
Well, no, you said how much did you buy it for back then?
80.
Let's assume they were assessing it at 50. Keep the numbers round.
Okay, so yeah, they're assessing at 50.
So 3% a year for the 30
now,
years.
Now they sold it last year.
Okay.
And last year they sold they were free and clear because it's over 30 years. So they sold it for $260.
Okay.
Now they took all the $260 they earned and purchased a new home for $270.
Okay.
So, but the new home's gonna be taxed on $270 purchase price, but they portability over. How would that work?
Okay. Normally, good. Thank you for the numbers, because that helps a little bit. So normally you're right. And they don't quite, well, but let's assume they're going to tax at full value, which they're supposed to do, even though they don't really do it. So in the example, the house was bought 30 years ago, let's say it was originally assessed at $50,000, now the house is worth $270,
Yeah.
and you're selling it and you're moving to buy something else for $275, okay? Without the portability, they would, all of a sudden, their real estate taxes would jump to a number based upon the purchase price of the new property, the $270. However, let's say that the property that they were selling, the fair market assessment, stay around, is $250. But their assessment, because of the Save Our Homes, is $150. It's gone up. So now you have $100,000 of difference. Now you go to the new house, you take the $270, subtract the $100, and now you're at $170 as your starting point for your real estate taxes. It's the differential between what the Save Our Homes number was and the current fair assessed value.
But this doesn't kick in until after the first year.
Oh, yes.
So-
So assessment, real estate taxes are assessed as of January 1. Anything, so if you're living, in order to take advantage of all these things, you have to own it before the end of December, and you file the papers during the year, and it goes back to the first of the year, and your tax bill comes out in November. Yes, got that?
No, I got it.
And if it's something personal or practical that you're looking for, the Broward County Property Appraiser's website has a great section on this that explains it with a calculator.
Yeah, no, I do use the calculator for my clients. It's just when you're explaining it to them, when they're selling and buying, because I have, last year I had to deal with that 4 times, the transactions. So it's just trying to figure out how to explain it to my works. I could put it in a calculator. You can put it in a calculator, it kind of tells you, kind of gives you what it is. But the problem I noticed, if you're jumping from county to county,
Shouldn't be any different.
yeah, but the county, because the county, for the portability, if you do it in one county, you could link the properties together, but when you're jumping from like Palm Beach to Port St. Lucie, you gotta kind of send it to them, and then when they assess it, they'll send it to you. That's the problem.
But it does work,
Yeah.
and it saves people a lot of money. And the whole idea is, if you've had advantage, without this, people couldn't sell the home, the bigger home, and move to something smaller because their tax bill would jump so high. I mean, you think about it, if you have a tax bill that's based on a purchase from 30 years ago that's been capped, and all of a sudden you go to fair market, your bill can triple. And that people can't afford that, especially if they're downsizing because they're reaching retirement.
And all, except for one, all the clients that I had were retired people that were paid, and they needed to move. They wanted to sell, but they couldn't afford the tax hike.
I'll give you a perfect example of how this works and how it's real on people. Before this occurred, before this law was passed, which I think was 91, I lived in Hollywood. And right across the street lived a gentleman who was a college professor from the University of Miami. He taught statistics, or as we called it back then, statistics. Nice guy, but he had bought a house in Emerald Hills on the golf course for $70,000. Back when it was brand new in the early 70s. And he was a business professor at Miami. Well, this house was now worth easily $300,000, $400,000. And he was paying tax on $300,000 or $400,000, and it was killing him. Because he was still a professor, he wasn't making that much money. He says, this is my $70,000 house. Should a person be forced to sell it? Anyway, the legislature came along and they fixed this. It may have even been a constitutional amendment, but obviously it was too late because by the time the law came into effect, his assessment had already come up to where the market was. So, that's portability.
All right.
Any other real estate tax questions? Oh, here's one more I want to just touch on. And again, I'm trying to do an overview of different areas, but this is good. Hopefully, we'll get into some more serious detail. And like I said, don't worry about derailing me because I want to cover whatever is interesting and works and is practical, as opposed to, things that don't have any real application, even if they're part of the real estate law, unless it's necessary. So, you hear about in commercial property, you don't have portability. You do have a cap, but I think it's a 10% a year cap, but you don't have portability. So what happens is, when property gets transferred, the property appraiser sees the transfer, and they immediately assess at the current value. That's a problem for the buyer, because the buyer is looking at the finances of let's assume it's income property. The buyer's looking at the finances, they're doing their NOI based upon what's given to them and all the expenses, and all of a sudden, that real estate tax number is going to jump. More importantly, if it's shopping center, office building, whatever, and there's pass-throughs, guess who's going to bear the burden of that jump? The tenants. All these numbers get passed right through to the tenants, and all of a sudden, the tenant's sitting there minding his own business. He's got a lease. In 2019, he was paying $300 a month as part of his rent towards real estate taxes, and in 2020, he gets a bill from the new landlord, and it's $700 a month. And he goes, what happened here? Well, big transactions with very sophisticated tenants, especially national tenants, they will come into a shopping center and say, we will not pay an increase due to a sale of the property. The landlord can't really tolerate that, because what happens is it takes away from his return, it becomes not so much of a net lease, but it's a negotiating thing. If the national tenant's coming in, relying on his credit strength, it's part of the business deal. Anything's negotiable.
You can cap it at a certain percentage.
You can cap it. A lot of things that we're seeing, and it depends on the market completely. Sometimes you'll see the landlord paying base year real estate tax as part of the base rent, and the tenants are only getting passed through on the increases. So there's all kinds of ways to do things. So if the taxes go up, they pay only the increase. It's not a pure pass-through, but that's not a triple net lease. That's called a modified gross. Okay? Next area of the law that touches into real estate is litigation. The biggest one, which we just barely touched on a few minutes ago, is foreclosure. People don't realize that a mortgage foreclosure is a title transaction. It's more than just going to court and having somebody take your property away from you because you don't pay. It's a title transaction. You're actually taking the title away from someone and giving it to the lender, or giving it to whoever's going to buy it at a public auction so the lender gets their money. The problem is, in doing that, the lawyers doing that foreclosure action have to check the title and find out if there's anybody else that has liens against the property, that could be subordinate liens, or anybody that has an interest in the property, and you have to take that back. You have to be able to join them in the foreclosure, anybody that comes after the mortgage, and it's got to be done properly. You have to have the right parties, they have to be served properly. We'll get into, just, again, this is an overview. But watch out for bankruptcy issues, appeals. Typically, if you're dealing with banks, hopefully they do it right. You can, I can't tell you how many stories there are of people, especially with the online auctions. They're going to be a hero. They're going to be a real estate investor, and they're going to log on and they're going to buy something at a foreclosure because someone told them it's a great bargain, and you can get properties really cheap. And oh look, there's an auction, and I can get this house for $29,000. I'm going to do it. Guess what? They've just bought a third mortgage. And nobody checks. They didn't look.
Tax deed.
Or HOA.
Tax deed's different. We'll talk about that later. Tax deed is very different. Tax deed will wipe the mortgage out.
Most common mistake is the HOA.
Just next thing on my outline. Association foreclosures. Association foreclosures are so casually done that most of the title underwriters will not insure them. Because what happens is, they don't check for mortgages, they don't check for judgment liens. All they do is they go after the owner because the owner hasn't paid their maintenance. And they can absolutely take the deed away from the owner that way, divest the title, but subject to anything else that's out there. So that's the worst level of foreclosure that you could buy the property for. That's when you buy the house for $5,000. The smaller the price, the stupider the bidder. Remember that, that's a rule. And just like the smaller the transaction, the more complicated it gets. That's just how things work. You get into very, very large transactions, and everybody is very sophisticated, and it moves much more smoothly. So they ask for stupid things. Okay, another type of real estate litigation that comes into play that you see in title are called quiet title actions. Quiet title action is a way to clean things up. You're examining title, you're trying to do a transaction and you find that somebody has a wild deed, a deed was done improperly, somebody didn't sign something right, all kinds of things. You actually go to court and you sue the people who purportedly have a claim of some sort, and you wipe out their interest. You quiet the title. You literally get rid of whatever's causing a problem with the title.
I thought you put out like ads in the newspaper and stuff, and then like if no one comes to claim, then it gets cleared.
Okay, so that gets into service of process, and happy to just delve into it, but I'll do more detail later. So when you start litigation, whatever kind of litigation, the court has to have jurisdiction over the parties. Plaintiff, the person who's bringing the action, files an action, and they name people. In order to bring those people before the court, you have to serve them with process. If I want to get a money judgment against you, I have to touch you. That means the process server has to come to you and hand you a summons, or somebody that lives with you, the right kind of person, a spouse or a person over the age of 15 residing with you, but you have to be served. In the case of a corporation, it can be an officer or something called a registered agent, but you have to touch somebody in order to get service of process. That's called in personam jurisdiction, the person. Publication is for what's called in rem, being the thing. So if you can't serve somebody, or you don't need to serve somebody because you're just dealing with a property right, you still can serve them personally, and that's always the best way to prove that you got service. Or if they are not available, and you have to show through certain proceedings that you tried and they weren't available, you can publish a notice. And the notice gets mailed to their last known address if you can find it, if they're out of state, out of the country, something like that. And if it's in rem, if it's only dealing with the thing and not with the person, you're not trying to get a personal jurisdiction, yes, you can publish. So it's limited. It's much more limited than you would think.
So a quiet title is a lawsuit?
It is a lawsuit, and it's a lawsuit against property, so yes, you could theoretically publish. Unless the defendant found out about it and came forward and said, hey, I live in town. He could have come and told me. I didn't know about it. He sent it to North Carolina. I'm not there. I'm here. That's not my address.
The only time I've heard of it is like, I've heard of people having properties that they thought went through bankruptcy, but they're still on title. And because I guess one of like New Century or some bank went out of business and they wrote it off on their books. So they have a mortgage there that was released. And so then.
No, it wasn't.
So, I mean, I've actually done a deal where it was released.
Okay,
And then we did a quiet title, and then it cleared up title and it got rid of it.
I don't want to get super technical with the title, but what happens is you can file personal bankruptcy or business bankruptcy, and the debt is extinguished. So therefore, you no longer have an obligation to pay the bank. That doesn't take the mortgage off the property. That's a completely separate thing, and you can't automatically do that. They still have a lien.
Well, I mean, if the bank is no longer existing.
Well, that's a different problem.
Yeah.
Usually the banks, you can follow a trail and find out where the bank went, who took them over. Yes, that was.
Some of them were just like releasing notes to get them off their books, and like you can find like satisfactions online and whatnot.
Well, hopefully, if you or I can just find a satisfaction online, then the title companies that are doing the searches should be able to find them too. Hopefully, not always. And by the way, there's an FDIC website where you can go for that kind of a thing, where you can follow the trail of institutions, because you know the banks are the best customers in the sign business. I'm sure most of you know what happened, that SunTrust and BB&T just merged. Now it's called Truist. So all over the Southeast, you're going to be sign people are going to be making a fortune. It's true, but it's everywhere. You know, you can drive by the branch that you think you know the name of, not even of that. There's just bank after bank after bank. And
They're going to change the whole.
Yep.
Everything.
Really? Everything.
Geez, do you own a title company, or do you work with a title company, or?
So we own a title company. There's a difference between a title company and an underwriter. Our law firm does have a title company, which is they do most of our residential transactions. But don't confuse a title company, which is an agency, with a title underwriter, which most people think of like Chicago Title Company, First American Title Company, Old Republic Title Insurance. Those are title insurance underwriters. Those are actually the companies that issue the title insurance. I'm an agent for them, which means I get raw material and I sign a policy based upon my transaction. That's different than being a title company. In Florida, lawyers are often agents for the title underwriters, but also sometimes we'll have a title company separate. If anybody in residential, I'm sure you prefer title companies to lawyers.
I mean,
Because lawyers screw up closing. Heard that before.
They make it very complicated.
What, lawyers?
Terrible people.
I've had very lackluster title agents, to be honest. They're very, very nonchalant with the files. And like, if they're dirty, then they don't want anything to do with them, really. Meaning, like, if there's title issues and there's liens and whatever, then it's like.
The technical term is lazy.
Exactly.
I mean, I've been examining title for 40 years. I could run circles around most of the underwriting because when I started, we didn't pick up the phone and call First American or Chicago Title and say, send me a title commitment. We got what's called an abstract of title. And when we get to that unit on titles, I'll bring one in because I saved one from 2 houses ago because nobody wanted it. It's a book. And it literally is every title transaction from the time that the King of Spain gave Florida to the United States. That's the first page. And as a young lawyer, we had to find that page because if that abstract didn't start with that, we had Black Lost Lands bounce it.
Who do you get that from?
Well, back then we would get it from one of the, what's called an abstracting plant, where they would go and assemble the information from the public records, and it would be certified. It would be certified to say that these are all the documents that relate to this piece of real estate. And from all the way back. And it was fascinating to do because you'd see who owned huge tracts of land all over the place. Another thing I'll bring in, just because it's interesting, is I have a 1959 Broward County land atlas. And you'll see names in there that are names of streets that you know, or maybe names of families that you might have heard of. You know, for example, not then, but going back to the early days of the abstract, there was a guy from Colorado who bought a bunch of land in what is now southwest Broward County, and his name was R.P. Davey. You might have heard of Davey, Florida.
Yeah.
Okay? There's, you know, maybe you've heard of, I bet nobody here has heard of a woman by the name of Lena Lyons, but you've all seen Lyons Road in Parkland and Coral Springs. So all of these names had a meaning at one time.
Boca Raton.
No, Boca Raton was called that because of the shape of the river and the inlet to the ocean.
But I mean, everything has a significant meaning.
There was a guy who owned one of the tractor companies, I believe, and his name was Arthur Vining Davis. And he was a visionary. He came here and he bought enormous tracts of vacant, undeveloped land in southwest Dade County. He bought huge amounts of land in western Broward County, and huge amounts of land in southern Palm Beach County. And when he eventually turned into a company named after him called Arvida. And there were, I don't know all the communities in Miami, but there was, some of the communities were like Country Walk and things like that were severely damaged by Hurricane Andrew when that hit. In Broward County, there's a little place called Weston that was all his property, and almost anything west of 95 in Boca. I'll come in when I bring the abstract and I'll show you things. I lived in Emerald Hills at the time. Emerald Hills is part of Hollywood. So in the 1920s, Joseph Young, who was the founder of Hollywood, anybody spend any time in Hollywood?
Young Circle.
Young Circle, exactly. See, these names all have a history and a meaning. So Joseph Young hired a company out of Ohio to pave the roads. So if you're going to build a city and sell houses, you need roads. The great hurricane of 26, 27, somewhere around there came through and destroyed the real estate market. It just wiped everything out in all of South Florida. He couldn't pay. So this company from Ohio foreclosed its construction lien. They weren't getting paid. They filed a lien against the property. They foreclosed it. The property went from, again, if you know the area at all, basically from Dixie Highway to 441 and maybe from Washington to Sterling that entire, minus a few little lots, but that whole quadrant was foreclosed, and it became owned by the paving company, and they formed a company called Hollywood Inc. I don't know if anybody's dealt with them, and Hollywood Inc.'s still around today. So anybody know Emerald Hills in Hollywood? So when they developed Emerald Hills in the 1970s, their cost for a house lot was 17 cents. Now they sold it for, obviously, but that's what their cost broke down for, because they developed and developed and developed. Oh, the story, the historicals are so. These abstracts are great. They were great back then in terms of learning the history, because you read all of this stuff. I mean, in the abstract of a house in Hollywood, this part is a foreclosure, because you have to go through this whole foreclosure of that lien, and it's section after section after section of land. There's a lot of land in there. Most of the abstracting companies reduced what was put in there, so it only dealt with the land that affected your particular property. But the history just keeps going on. So little by little, it got smaller and smaller and smaller, and came down to, you know, individual property that you were dealing with. That's title examination. Foreign investors. So we've had, obviously in South Florida, we've had a great influx over, I don't know, the last, I don't know how many years, of foreign investors in real estate. So, not just in Florida, but all over the United States. So what used to happen was, somebody would come in from Europe or South America or Asia with a boatload of money. They'd buy up property, they'd hold the property, whether it was income property, land, whatever it was. They'd sell it for a huge gain, and they'd leave with the money. It was their money, there was no problem. The problem is, we have income tax in the United States. These people weren't United States taxpayers, and therefore they didn't pay any income tax. So there was all this huge amount of money which was technically subject to tax in the United States because it was US-based income. They weren't paying it. It was a non-US person who comes to the United States and earns money in the United States has to pay income tax to the United States. The federal government passed the Foreign Investment in Real Property Tax Act. It's called FIRPTA. And I'll go through the heavy rules as we get into that a little bit more. FIRPTA was designed so that some tax would get paid. Originally, the original law was 10% of the gross proceeds of sale had to be withheld at closing and sent in as a withholding tax. Not a tax, a withholding. So that the foreign investor could then step forward and say, wait a minute, I'm filing my tax return, my gain is only this and you held too much. You get the money back. Most of them just, the gain was more and they just left and didn't worry about it. It's since been raised to 15% because they determined that the 10% wasn't enough. There are exemptions, and all you have to do to get around it is, if you're a US taxpayer, of course a citizen or resident, all you have to do is fill out an affidavit at closing that says, this is my social security number, I live here, and I'm a US taxpayer and you're exempt. There's other exemptions, but so FIRPTA was passed for the purpose of capturing some of that money, at least in terms of withholding. There's other more technical stuff, but we'll get into that another time. Title exam, we're talking about underwriters, searches, gaps. I'm going to do some more detail on title exams and various things it deals with. Just see. So that was the overview of all the different things that are involved in real estate practice. And kind of like a little bit of a preview of some of the things that we're going to be able to talk about and discuss, and obviously in more detail, plus other stuff. I mean, you see what I put into the outline, and just trying to see if there's any more. Any other general questions?
It's kind of specific. It's about like a certain type of transaction where you're doing some type of creative financing in residential, and the person that you're buying from has a mortgage, and you want to take it subject to without like triggering anything, in type of like do on sale clause or anything like that. Like how you would go about that?
Very carefully.
Like would put it in a trust or something?
Very carefully. Because, see, I'm going to tell you, as a lawyer, when I start dealing with people and I hear the first thing, you hear the word creative, okay? When you talk about creative financing, red flags are gonna pop right up. Okay, you're gonna do something, you're dancing on something. The seller is breaching a contract. There are ways to do it, by the way. The seller is breaching a contract.
If there's no prepayment penalty?
We're not talking about prepayment penalty. You said that, you used the
Okay,
phrase.
so-
Nope, you used the magic words.
Creative?
Due on sale.
Oh.
Okay, but if you read the mortgage, and I'm not gonna torture you with reading your mortgage, but if you read the mortgage, it's more than the word sale. There's a whole couple of lines as to what it's defined as to what you can't do to transfer. And that applies, by the way, in leases too. If you're a tenant in a lease, and there's a prohibition against assignment, my leases will say something to the effect of, if the tenant is a corporation, partnership, limited liability company, a transfer of 20%, 25%, whatever they agree on, or more of the shares of the company is deemed to be an assignment. You can't do that without the landlord's consent. But yeah, there's ways around it. There's ways to try and hide the transfer in a due on sale clause. It's, not a good idea, because if you get caught, then they're gonna call the mortgage. So it happens.
Or like doing the transaction and then not recording the deed, but having like a signed deed or something like that.
Good sigh, thank you. Yes, you can certainly do that. Here's the risk. The risk, now you put the risk on the buyer. Because now, where's the title at this point?
Well,
Where's the recorded, in your example, where's your recorded title?
with the buyer.
No, you said the deed's in the desk drawer.
That's where it's at.
So who owns, of record, if I look at the public records, who owns the property?
Oh,
Now, if the seller goes out and gets into a car accident and doesn't have enough insurance and gets sued for $1 million and a judgment gets recorded, what happens to your buyer's title? There's $1 million lien on it. So, and by the way, the seller doesn't live there anymore, does it? So it's no longer his homestead.
it was an investment property.
Right, worse,
Yeah.
worse. So by doing that, you're exposing the buyer to a judgment entered against the seller, which becomes a lien on the property before the buyer even gets title to it.
Okay, but the lien is still already executed, but the lien just has not been, the deed has been already executed. So it's been,
And can't you file something in addition to doing
no,
that?
it's only, what I'm trying to say, it's not, even if the buyer thinks it's executed because it's been stamped and signed, but it hasn't been registered, so it's kind of just paper,
So registered, the real word is recorded,
recorded.
okay? And when you record something, that's when you put other people on notice of a transfer, okay? If you don't put them on, and again, this is title and recording and things, if you don't do that, if you don't record it, and I get to the courthouse before you do, I win.
Yeah, it becomes paper. Well, I mean, your deed at hand becomes paper because you got to the court before.
Well, no, actually, in reality, between the buyer and seller, it's a contract, and the contract has been delivered. Title actually is transferred from seller to buyer by the delivery of the deed, but by not recording it, you're not protecting the title.
That's,
So, okay, so if we put it in a trust and then the bank calls it due, what happens?
Well,
Who's it gonna call it due on?
it doesn't matter because, okay, you got two issues. Number one, somebody signed a piece of paper that starts off all the way at the top with the words, "I promise to pay." If you go look at any note, that's the very first line, "I promise to pay." So that person that signed that is subject to the bank saying, "Pay me." In addition, there's a mortgage on the property. So whoever owns the property, whether they own it with a deed in the drawer or they own it with a proper deed, if that bank doesn't get paid, that bank comes ahead of and can foreclose out everybody below it. So now, it's funny because I just want to tell you something else that I looked at and forgot to mention, going back to the taxes and these kinds of transfers. Remember I said that in commercial property, when you transfer the property appraiser is going to reassess and bring the value up. Well, people, I got an idea. I'm going to put the property into an LLC, or I own the property in an LLC, and just like your secret second mortgage thing, no, there's nothing wrong with this. I'm going to sell you my LLC, so the property appraiser can't see it. Can't see it, you're not going to reassess it, right? That sound like a good idea? Department of Revenue got smart, which is very rare. Department of Revenue is generally stupid. And they said, when you do that, and you're certainly entitled to do it, and by the way, with a few exceptions, you don't have to pay transfer tax, the dock stamps I was talking about, if you sell the entity. That's an old rule with one modification. But what you are obligated to do now by statute, when you sell the entity, is you have to send a notice to the property appraiser saying there's been a transfer of ownership. And what happens if you don't? If you don't and they catch you, which they will, they can go back 10 years, up to 10 years, and find that transfer, and not only assess the tax, but interest and penalties on top of it.
The IRS should have counted it.
No, this is property appraiser.
But what if they put it in a trust and then sell the rights to the trust?
Almost the same thing, if you're selling control.
Whenever
No, but like subject, taking a mortgage subject to or buying a house subject to an existing
It's
mortgage.
legal. That's legal, but you're supposed to get permission from the bank if there's a due on sale clause. By the way, there isn't always a due on sale clause. Almost always.
But it's like, it's like, I'm not gonna say it's a fad, but like a lot of people are building out portfolios that way with little to no money out of their pocket because financial distress situations or whatever, and they'll take properties subject to that are
Okay.
cash flowing.
Because what, all right, again, right now we are in good times. And I don't know,
and I've seen this before 10 years ago. It's
I
exactly.
was just about to go into that. There is a slight differential in the room between people that were involved in this business 10 years ago and people that are seeing what's going on today. Well, it's with its age, obviously. So 10 years ago, when things were going crappy and you knew your house was going to get foreclosed on,
You rent it out and let it get foreclosed, right?
either rent it out and collect the rents, or you got the guy that would come and give you $500 for a quitclaim deed, subject to nobody cared, because then he would do the same thing. And by the way, this was not my first recession. I was involved doing foreclosures and this kind of stuff in the late 80s and early 90s. It actually was dirtier then. So you had guys that would do the following wonderful trick. Your house is in you're going to lose your house. You can't pay it. For whatever reason, so I come along and I say, here's $1,000, $500, whatever it is, give me a deed. You give me a deed. You go. I now take the deed and I convey it to 8 different people, some of whom live in South America, some live in Europe, some live in Colorado, and 3 corporations that good luck finding. Okay, so now I've splintered the title all over the place, which is a headache for somebody foreclosing. Then I put a tenant in there, or I have an operator, or that's one way to do it. I put a tenant in there, and every month, obviously I get my $500 or $1,000 back very quickly, but every month, the deal that used to go on there, not everybody's reputable, lawyer would make a deal with the operator, for lack of a better word, and the deal was every month that the lawyer could stall the foreclosure, they'd split the rent. That was the deal. And there were a couple of lawyers, especially in Dade County, who had all kinds of techniques like that, like what a splintering type of thing, or they'd file motions, do all kinds of things to delay and delay and delay this foreclosure process, because each month they got rent.
And then you had guys out there going around collecting deeds after before.
It was a business.
And it's a business, so the attorney would have a trio of guys going out there and collecting.
But that's them intentionally getting a property that's gonna go into foreclosure.
Correct.
As opposed to a property that's healthy and someone just wants to step out.
But there you're usually going to just buy it, if it's healthy.
But then you have, transfer title, you have to go get a loan for the whole thing, and it's just like, it's like way more cumbersome than.
You can acquire subject to, there's no question about that. You can ignore the due on sale clause and hope you don't get caught. Or you can go to the bank and ask for permission to take it over. But it all works.
But to talk about what happened like back in the last silent crash, this time around it wouldn't even work for an attorney or a group of people to do that because of the fact of the shortening of the foreclosure process.
Well, yes and no. Good. That's a good segue. Thank you. So what happened the last time, and it probably continues, is the foreclosure process got from being like pure normal day-to-day litigation to being a mill, where you would have either law firms, big law firms with a department, small law firms, people that would like just process foreclosure paperwork and go through it, just stacks of them. When I did it back in the like say late 80s, early 90s, each file was, I did everything myself with 2 secretaries. I went to court, sat in front of the judge. It was just like a normal, mostly uncontested litigation, as opposed to, we had a foreclosure department also. So you'd have a room like this, in each chair, the person had a different function. This was the complaint person, this was the service of process person, this was the affidavit person, this was the hearing scheduling person. And there was a lawyer overseeing all of this, but it was a machine. And most of them aren't contested. But if something got contested, badly, like you started to file real defensive papers, you hired a lawyer and did all of that, if they've got this many files on their desk, that one with the bad pleadings in it would get moved to the side. I'll deal with this later, I gotta get through my stack today. Now, we had a separate contested group that would take those files right away and jump on them. But a lot of firms, I did, before I couldn't do it anymore because our firm was doing the plaintiff's work, there was one where they just typed the name of the bank wrong. And I filed motions, this plaintiff doesn't exist, and it didn't, because they had words, things that didn't exist. Motion to dismiss, and it was a defensive pleading. It took months for them to respond to that. And my client was in the house. So there's all kinds of nonsense that goes on. I probably should have mentioned this earlier, but one of the things I learned from last year that we're going to be doing is at some point towards mid-session, we're going to take like a 15-minute break. Give you guys a chance to get up, go to the bathroom. And obviously, that doesn't mean don't get up if you have to, but I forgot to do that as part of the housekeeping. It's too long a stretch to not do that. And whether I do it at 2 or 2:15 or something like that. For some reason, I swear last year was 12 to 4. They moved it to 12:30 to 4:30, but I could be wrong. I just know that, especially for those of you that have the finance course in the morning, that last hour, you don't get so much participation and attention. It's more like The Walking Dead, except they're not walking. It's understandable. So, and for the most part, I try not to shortchange, but if you're dying, we'll end early if we have to. The only exception to that will be next week. I won't go all the way to the end because I have to get somewhere. But other than that, no.
Next week will be the 18th.
What's that?
Next week will be
Yeah, normally I would say, okay, after class, questions, I'll stay and answer questions, but when class ends next week, I'm going to the airport.
But we can ask questions after class, right?
Oh yeah, absolutely, and that's normal. Or during class if it works, but if they're really pointed, specific stuff, better to do it one-on-one. Happy to do that. So, and then I figure what we'll do is we'll take the break, and after the break, we'll dive into the contract and the things that are over. Is that all right?
Yeah.
All right, might as well. It's just a couple minutes before 2, so take a breather.
Let's give you another one that we didn't want right now.
Yeah, it's coming. It's coming.
I can't really get it.
You all right? Do it.
Happy New Year. Hey, y'all finished this semester last year?
For the most part, yes. There'll be some materials.
Flip residential properties, like distressed assets, I find them that I mean, when I'm trying to do
If you're picking,
yeah, have you ever heard of Bullseye? Yeah. But now I'm trying to like figure out other ways.
I think they answered yes for the most part.
Like 2 years, like on and off, like 2 years. I was like, I did it for a year, 2 years off. Like last year, I was like,
So,
Before you put up question,
That's
No, I had a lot more. My dad had open
I know
source.
it's
Last time that was
I don't want
my wife was trying
I don't do it anymore,
Oh, yeah.
because I just like, do I have like spots for people,
If you were in
yeah,
San
my data
Diego,
cleaning it,
Sure.
you know.
I was already, no, I was, so I kind of figured that, like list sources, I kind of figured I was
If I
graduate
get lists from other sources, I go to the county, buy from other sources, I track my dollars.
and I didn't take no Gale classes. I didn't take
Talking
no
me out of my
Gale
first
classes.
run.
No, but well,
Wait,
for me,
that's
it's,
on nightmares later.
I did both of those classes back to back, and that's all I gotta worry about.
I used to do that in Science not anymore, they're kind of very expensive. I do texting and cold calling.
oh, you do foreclosure?
Yeah, RBM.
It's illegal.
Is it?
Yeah. Yeah, you can get away with it, I know a lot of people do it, but
What's so bad about
I
it?
don't even get sued for like
How do you teach the same class every year?
Yeah. Yeah. I did well like my first year working in mentor and then I got up to just like a local investor, you know, like I was just bird dogging.
How do you ever did leave alone? You got this job or internship?
Yeah.
Is it
I
paid?
did pretty well and then
Nah, they try to get me from Palm Gardens, right?
It's for Palm Beach.
And
Oh, Palm Beach.
and then I started like
These guys just stopped at the school.
and then that it's not really me.
Intern with the
And now I'm back in it, and I have like one sales guy and a VA that I work with, and now we're trying to
Are you
figure out,
gonna
I have
be
two
in
right
ULL?
now, one in probate, and I should be closing soon.
you have to pay.
It's like a 50
For real?
condo.
Okay, is that?
No.
Pay like for
Written in the job.
I know, I'm not opposite. I was like,
Wait, but how come when I click, it says like 400?
Yeah, if you're a student.
yeah, no,
I
like
have that one, and then I have
Yeah,
a
it's
couple,
like
like, I have a
resume
couple,
I'm gonna be using that
like
for
creative finance.
Right.
Yeah, I know a lot of things. They're not gonna catch me.
Stuff like that too, and it's like,
Are you really?
you
No,
know,
yeah, you gotta get this.
the reason I'm asking is I have this lady,
That's why I've been
she wants to like
Because I want to go to the.
walk away from her property, and she's like, give me $5 grand, and it makes $800 a month. I'm like, what?
It's like, work for you.
Because I can get that.
Yeah, I got the
situation,
email.
sell it, you know what I mean? I can sell it for like, you know, hey, take my position for $5, $10 grand.
Yeah, those conferences.
No, and then if you use like architecture stuff or whatever, I just put
Oh, really?
the e-bag drive. And I have it for like 3 years, and you can even renew. Like I but like it'll show like
Yeah, Brian, yeah, I know, he's creative
But
financing
just
manager.
That's right. It's free, and otherwise it's
That's what I'm saying, it's like he has portfolios of 10s and 20s.
I
don't know how many properties he has, but
What
He
is
has
it?
multiple properties, that's what he does.
There's 2 initiatives that are.
It's just kind of going all in, you know? Like, I don't want to wholesale, honestly, like, I was doing.
It's like a lecture style.
No, it is,
But
and
there's
it's like,
two-
he has like a
there's
security,
midterm
like,
flag.
it was the next.
That's it?
I don't know what that's on. I'm paying
If I pull
attention.
this one, and I can get a couple more, because the house is
People
already
just,
equity,
I think like,
you know, take over, especially if it's already.
Yeah, yeah.
where?
So,
I printed it out. I'll show you. It's just like an outline.
Just a
Was on campus?
they range, they range, I mean, like, we're making 7.5
Wait for him
on
to see
one
email.
thing.
Oh, you're that annoying person. Wow.
I was like,
Like,
hey,
you have shit to do, and you're like,
if you're not gonna.
give me the syllabus.
I was still nothing I'm not gonna ask.
Stuff like that, like, I'm trying to raise money.
For what?
So
What?
like, so that instead of like wholesaling the condo, I would just buy it
Oh,
and.
yeah, I asked him, like, what are we supposed to do for the first, like,
Yeah,
because, you know,
I don't want to do rentals, I want to.
usually when they want you to have, like,
oh, make sure you have it.
The reason
Yeah.
Yeah.
It's just an outline. There's no like homework.
That's
Like
like,
really.
Yeah, I knew about it 2 years ago.
that's it right there.
Yeah, and I
All the letters
But it was bullshit because I purchased the text.
I did too.
I just opened my own.
And it's the code that you can't return.
for real?
So I'm just reading it for fun because I paid for
Once
it.
you open
They
it.
almost have a negative.
And you had
It's simple and
I
everything.
should have waited for the first day.
Right?
You bought it too?
But on the other side, like people like Brian are making fucking,
This is awesome.
you know, 10
No,
grand a
that's
month.
like for
So it's
for
more
like
money
the
out of
whole.
pocket in taxes.
So like when.
But it's just like.
That person, it was a woman, that person. And like, it was like one of these things I just looked at, then that, but it was always in the back of my mind until last,
No, yeah.
until last year when I laid off.
I don't know how we're getting tested on this, but.
I was like, okay, we need to do something different this year. I've been looking into it more and more, so that's why I was like, okay.
Yeah, bro, I mean, if you wanna like, I don't know what your strengths are, but I'm down to help you, especially if you're hustling yourself.
It doesn't really, I mean, unless it's.
No, I'm just doing, I mean, how, you said we have 15 minutes or 5 minutes?
Well, it was 15 minutes when I let you go, so.
Okay, so we got like 5 minutes left.
If you're an artist, it's cool.
You have a depreciated 15 minutes now.
It's not that special.
So in terms of the, I'm just gonna keep picking Brandon.
Yeah.
So
Except there's something left.
So I spoke with an attorney who runs title company for this other transaction because I'm new to it.
Okay.
And so
Someone's saying.
obviously, you know, everyone's having different. So he basically, he wasn't super familiar with it, but he suggested putting in a trust and selling the beneficiary rights to the trust. And then so that way it doesn't alter anything because the banks ultimately don't want to call the loan due because they make money on the interest over time. And so if the payments keep getting
Ultimately, unless, yeah, okay, so ultimately, that's right, that they do want their payments more than anything else, but some of them are picky. I had one where the client took the property because out of their personal name and put it into their own LLC. No change of ownership. Just there, somebody said, put it in an LLC, protect yourself from liability, whatever the reason. They got a notice from the bank because it got picked up in the taxes, it got picked up in, and they said, you're in default, move it back or we're gonna call the loan. And they, even though there was nothing to it, it's technically, now, you said trust, again, you gotta, I don't have, you're lucky, I don't have mortgage documents with me. But if you pick up a residential mortgage, Fannie Mae mortgage.
Can I get that through like, if I get an authorization from the seller, I can request their mortgage, like how would I get it?
Well, public records.
Really?
Sure.
I can
It's recorded, just the mortgage, not the other loan documents. Mortgage is a recorded document.
And the mortgage will outline if it has that?
Right, exactly.
Okay.
So, I'll tell the paragraph 17 story another time, but back when it started, it was a particular paragraph in the Fannie Mae mortgage, and there was litigation over it because when it first was put in there, people were saying, no, you can't do this, you can't restrict me from selling my property. Because it was common up until a certain point to sell subject to, and it was done all the time. The banks then put that in there, and there was all kinds of litigation, and the litigation got named after literally the paragraph. But I believe if you look at it, you turn on trust, it will say more beneficial interest area.
Okay, so.
There's, I mean, you know, the banks have lawyers too.
Yeah, not exactly. Yeah, and I mean, and the main thing is just like not having to get a new loan, not having to deal with new insurance, not having to deal with closing costs, not having to deal with anything, you know what I mean? And really just paying out her equity or whatever that she wanted, so. That's where like at least the thinking is coming from.
Yeah, but you're taking risks to do all of that.
Yes.
And the question is, are you better off with, you know, investing a little bit more and having a completely clean transaction where you never have to look over your shoulder?
Well, I mean, the problem
Yeah,
is
that's funny, it's like you can shake the box.
it's really,
This is 150.
it's really close, so basically, the transaction
Get
is
it
like,
like pirated or something.
it's probably worth around 95. I mean, there's a comp that's
And I was
95 would
scrolling
be worth a
through
little
it,
bit
it's
more.
not-
And she wanted
not
90.
that, like,
so
I can't say
you
it's
know,
worth,
it
like,
less, you know, a little bit worth addition. And it just doesn't make sense at that number. But, you know, at a retail sense, you know, there could arguably be like $5 grand equity. And because the property's cash flowing,
Like all
it's
log
like
in,
an
like 30
alternative
people
creative
with different
solution to her
servers.
issue of wanting
They're
to
like,
walk
damn.
away. There's no one else who wants to buy it for $90,000. But
What's it really worth?
Oh, yeah, but I would be in the.
like it's in the surrounding houses are in like the 130s, but like that's across a major road, and maybe over time. But I would probably say around 95.
Renting it, is it rented out?
It's rented out, Section 8, everything, it's a rental property, it's like ready to go. It's literally,
It's another thing you gotta be a little careful of.
Do we need it for this?
And the government.
What about the other one?
What are
It's
those?
the same book.
Where the money's going. Maybe that's
Same
gonna
book.
cross report this.
I rented it last time, I returned it.
For the.
Oh, this one?
yeah, I don't know, and I don't know, like, how do I
This
figure,
you
you know what I mean? I
this
have to
is-
figure this
this
stuff
is
out to make
just
sure that.
networking.
I'm more, it's how I can't.
How much is this book?
So, I guess the next step would be to look at it more on.
I just did my MBA like.
I mean, again, the easiest way.
I actually
is the
degree
cleanest
got
way.
mailed to me in October.
That way, like,
Oh.
you never, you'll find people that want the money.
That's why somebody got no real estate.
You want to start this.
The houses you buy, if I'm like, because when I
When
was
you
like
bought this?
buying
Yeah,
houses
was
in
it
distress,
180 or
I
280?
buy them like at 50% of the
That was
value,
two-
and I sell them to investors who want to hold them, or
150
fix and
rent.
flip them at like 65%, and I keep the margin. So for this house,
There's
I would
actually,
be
you know what?
substantially
There's a
lower,
website you can
like
actually
substantially
download
lower
books
in the price, but because, you know, it's rented, it's in shape, it's, you know, it's good to
You
go.
know, let me go find the. I'll find the link because
For equity for the position.
it could be an older version, or like
that
an older
is-
version of the book, but still same thing.
Yeah, like I just assign it.
And that's where like we never like I found out
Most of
about
them,
the
sometimes they'll
website
double close,
like 2
sometimes.
How does the
semesters
investor
prior
rate
to
work?
graduating.
Cash or if I-
Yeah.
So you're gonna pay them.
I am.
Well, not for this one, it
Was
doesn't
your
make
background?
sense to do that, because
Okay,
the
yeah,
price
yeah,
is
yeah,
too high.
definitely.
Because she owes 85, she wants 90, I would need to pick it up at like 45 if I wanted to do that, and sell it at like 65.
Oh, you can't sell 65 to the mortgage 85.
Exactly, so that's why, the subject two is the only thing that makes sense.
Yeah, no, that doesn't, no, because you still,
But not for
Because
I would
I'm
say-
willing to keep the debt there, exactly. I'm
no,
willing to-
no, the problem is you're it's under the very
On paper,
high
yeah,
valuation.
because I was like,
Yeah.
And that's not a good
I
investment.
would have done better.
Even if you're only paying
Had
half
a
for it,
computer.
you still
So now,
have
so
to
when
pay
you said,
800 bucks.
you know, open notes, you know.
The house that's
no
leveraged
computer,
correctly
and
is only
like,
capped on
I walked up to
$500.
him and I'm like.
So that's why it's like a unique
My computer,
Okay,
he looked
I
at
hear
me
it.
like,
Yeah.
okay, tough luck.
He don't care, no.
But again, you know,
I was
I like
like,
to,
okay,
you know,
so
hear your.
There's
tough
no
luck.
one in the world.
I'm a little
That's
concerned
right.
because I've seen,
See,
so
okay, tough luck.
I own no real estate other than my
Email
home.
like this one.
And I have friends and my
Words.
family.
Handwrite everything.
Huh?
Handwrite everything.
Yeah.
All the
Use your
great
calculator.
stories you hear, and there's
Yeah.
lots of them.
Lesson
I'm
learned.
very rich
That's the
with
way to
my
pass
clients.
40,000.
No one hears the bad stories.
Lesson learned.
You know, it's like the guy that told, when they foreclosed out the 3 houses at
Oh,
Cape
I asked
Coral,
him about
and they said,
Yeah.
yeah, but the first 10 you get a lot of money on.
Oh, these
You
guys.
get those kind of, but you gotta have the stomach for it, and
Yeah,
not
but
care
it
about
was-
the foreclosures and things
That one
like
was
that.
simple.
Because especially if you're getting started.
It was just
at
script,
the credit
just had to
side,
multiply everything by the
you gotta be
script.
really careful.
So who
Huh?
Pretty much, yeah, with the vibe.
in worst case scenario?
He
I
said.
think it was easier than last
Seller?
class.
Yeah, to the seller.
Because I'm now the owner.
Well, you would be joined if they knew that you had an interest. First means your name lines up in the documents.
I don't know. I got
I'm
a
just
second.
Yeah,
that's
what I'm saying.
No, but this time.
That's a right.
So I thought this time.
And
was-
then it was-
To get to that too.
Yeah, but also the first time, I didn't know that there was a quiz.
I'm not discouraging you from making money on it.
No, I was careful, no, I like
I was ready
because again, you know, there is a one sale clause, but sometimes now, people are saying that the banks don't really,
Who's bank?
that's a good question. That's a good question.
No doubt.
But yeah.
I don't think this smart water is for real. I know the Thin Mints didn't work.
He's gonna spend $5 about it. I guess it didn't do its job.
I just went to the water fountain with the bottle. I bought the bottle at lunch because it wasn't that much more than the Dasani, and I can't make a joke with Dasani, so.
Smart, well, $5 on my next.
There's something in it, I don't know what's in it. Not brains.
Lead chromium, oxide.
Oxide?
Stuff that they use to make aluminum.
Yeah.
Anything to make
Imagine
like
drinking that, right?
Say it again?
I said, imagine drinking that.
No,
It's like asbestos.
I grew up drinking fluoride and chlorine because I lived on Miami Beach, and
We still do.
the water came across from the city in pipes that were old and decrepit, so they added fluoride and chlorine to make it clean. So I can drink a swimming pool, it won't bother me. And I didn't have a cavity until, and I swear he put it there, until about 3 years ago, so. Okay, if you're not back yet, raise your hand, please. So apparently, there's resources that I didn't quite figure out how to use right last year, but I'm going to try and do a little bit better this year. There's something called Canvas, which I can post things. Sorry, you know, it's funny, as an adjunct, I come in here and they gave me some instruction, but nobody actually sat me down and trained me on the systems. I'm reasonably good with figuring that stuff out. I spent the last day and a half at home fighting with my network and my sound system, but I conquered it this morning before I left. Made me very happy, but very frustrating. Anyway, I did put this contract up that we're going to talk about because I don't know about you guys, but I don't like paper particularly. I've gotten to the point where I'm pretty much paperless at work, which is amazing. I have a scanner and everything gets scanned in, and I do a lot of my drafting on the screen and reading things on the screen. Anyway, you've got the contract piece of paper, but I also put it up. Please let me know if you see it at some point, so that I know that it's there. Someone asked a question during the break about the fact that we don't, you know, if you're not using the book, how are you gonna know what's to look for on the test? Primarily, it's what we're talking about in class. Not necessarily so much from the overview stuff, because what I did this already today was really more of an introduction to kind of set up some of the topics and what we're going to be talking about and working on to kind of get some flavors to where we're going. Obviously, the specifics of the contract, the specifics of the things are important. Now, the syllabus was shortened from an outline that I had prepared. So what I'm going to do, just so you have a little bit more guidance, is I'll post the longer form outline, so you'll be able to see that. But somebody just let me know at some point if you see the contract up there as an assignment. I don't know quite where to put it. If anybody's got any suggestions or knows how to use this system, I'm also easy as a student. So anyway, I'll try to put that up there. My exams are going to be multiple choice. I don't know, I mean, I suppose I should have done this as early housekeeping stuff, but think about it. We do 2 exams, a midterm and a final, equal weight, and although it caused a little bit of controversy last year, I did put 10% of the weight on class participation because it helps everybody. So what I decided to do with that is not everybody wants to jump up and talk and get involved. And I understand that. So I'm going to try not to use it as a negative. I'm going to try, so for example, if somebody's got great test scores, and they obviously have a good handle on the material, but they're just not the kind of people that get up and talk in class, that's fine. I'm not taking anything away. On the other hand, if the test scores are a little weak, then, and I know that you participated, then I'm going to give a little extra credit for that. That just seems to be the fairest way to do it. The other thing I'm going to do, and I'm going to wait because there's still a couple of people missing, is I think we have I don't know if I'm supposed to be taking attendance or not taking attendance, but I would just like to get a quick idea of doing that. Okay, we're pretty close to everybody. I don't know, 1 or 2 people. So if you don't mind, Gym Alliance, good start. And please, if I'm messing up the pronunciation, I apologize. Cole? Here. Everard? Thank you. Adam? Thank you. Caesar? Thank you. Jose? Pablo. Okay. Claude? Nisha? Ahmad? Connor? Judson? Thank you. Jose G. Jean-Pierre? Oh, sorry. Comma's the workplace. Christopher? Elizabeth? Laurel? Oh, thank you. Well, interesting too. Let's see what I'm missing here. Okay, good. Thank you. Whatever it's worth. Can't promise I'm going to remember. Yes?
Sorry, so I get this correct. So the exams are going to be based on the lecture that
Yes.
you're going to give every day. So what is the usage of the book then? Just trying to understand.
Background. Okay, I'm sorry. I started this early on, and I don't know if you came in a little
Yeah, I'm
late.
sorry, come in.
No, it's no problem. I said I wanted to do it again to make sure. So last year, the department assigned the book. They said, here, do you want this book? I said, yes. I looked at the book. I said, okay, I figured a class needs a book. But you have to buy the book. I didn't really teach from the book. A lot of the subject matter is covered in one way or another in the book. So if you're someone that prefers to learn from reading, you can get the book and get generic information about contracts and title and things like that. You may get more detail on some things, less detail on others. I tend to be more practical. I tend to be more spending the time on the contract provisions, which we're going to get into in a minute, and how they work and why they're there, as opposed to some of the things that you'll find in a textbook that are great in a textbook, they're great to put on a test, but they don't do any good. It's like, I remember when I was in college, back when I went to college with Fred Flintstone, and I had to take economics. And the professor would go and he would fill the blackboard end to end with formulas and terminology, and it was fascinating, and he was great, and he'd get to the end and he'd go, of course, this doesn't work in the real world.
So why use it?
Thank you. What's the point? Now, for theory and trying to steer the economy through the theory, yes, I understand there may be use for that kind of stuff. I don't say the same thing from what I've heard about your finance class that you were having in the morning. Because at least the stuff that I heard you talking about, and the things that I've heard the students talking about, some of it, yes, some of it's heavy math that you may never use, but some of it's real practical and real good, working with commercial real estate, working with any kind of an investment, so it's important stuff. Okay. Did I answer your question?
Yes, you did.
I don't want to force you to buy the book, because I don't think it's super helpful.
I wish I would have known that.
Yeah, we should have known that before because we pay for it. So.
Okay. Well, it won't hurt you.
So now the ones that we have it, what would be your suggestion in terms of going about? I know you said that there is some concepts in the book that we can use, but there is no format. As I tried to match the outline that you had to the book, and I couldn't really get.
That's the problem with the book.
So to me, it's just, I'm sorry, but it's just to me a waste.
But since what I find is it's a digital book.
That's what I did. I paid $100 on that.
Control F, you type in what you're looking for, and it should bring it up.
I did that.
You have the ebook?
No, so like a few things, but it's not matching at all to what your outline has been. So.
Well, I will say this to you.
I'm trying to find a way to prepare before I come to class and try to understand what you're going to talk about.
So I'll make this offer to you. If you see things in the book, because I have a copy, if you see things in the book that you don't see in the outline, that you think maybe would be important to the group, tell me. And I'll either say to you, no, that's ridiculous, well, I'm honest, or I'll say, you know what, that's a good idea, let's incorporate that and let's talk about it. I'm happy to do that. Like I said, I'm really flexible here because I haven't quite figured out why I'm doing this, but I have fun with it, so that's why I'm here. I'm sorry, your name?
James Alliance. Well, it probably is Jim on your Alliance is the last.
Thank you. Excellent. Now we're just missing one. Okay. Sorry, where were we? I missed. Were you gonna ask a question?
Yeah, so on that, I walked in, so he was going, I was trying to figure this out too, because I got the book and I was trying to figure out how each class lined up for the chapters in the book. It
The
doesn't.
classes don't quite line up, and I'll tell you why. I kind of shuffled my lineup. Again, I didn't, last year I didn't do it from the book either, but I had the book and, you know, I looked through the book for ideas for things, but, so, unless I undid what I was trying to do, I tried to stay in some kind of logical sequence, because, for example, first thing you need to do is buy the property. All right, and I'm trying to be transaction-based to the extent possible. Then you have to pay for it. So the way I set my outline up is we're going to look at the contract, and then we're going to look at how to finance the acquisition and the things that go with it, and then other things like how to fill the property up with leasing, options, title, all those kinds of things in some kind of a logical order. So I didn't write the book. Go ahead.
No, I understand that, but the purpose of the question is, okay, there's material being provided for us to understand and learn, to provide that we have some kind of understanding for testing purposes. So how do we prepare for the test, or, because I know I missed the introduction of the class.
So the test is going to be based on what we're talking about in class, which is based on my outline.
Okay. And
the book is background material.
And then how's the test is going to be? Because
multiple choice.
Multiple choice. So basically, if we need to make sure before the test come in, all these keywords you have here, what, where, when, how much, whatever, we have to get a clear understanding.
You're going to see in a minute where that comes from, and more like, you're going to catch the key points.
I get it, because I've been real estate for so long. I get what how the transaction, by looking at this, if you're familiar with real estate, I understand, but I'm more worried about how is this going to be applied for, what do I need to know about approval or permitting or inspecting? You know what I'm saying?
Right. Okay. Figure it out. We'll get through it.
All right.
You know, my concern here is how can I prepare before coming into class? For example, I've never been in the real estate world. So when I come here, then I'm gonna be a week behind because, you know, this next week I'm gonna have to prepare to understand what you're saying or relate to it. So that's why sometimes having the outline with the book, per se, as you know, other students are used to, helps you to prepare for that lecture.
I'm going to post a longer form outline.
Okay.
That'll have a little more detail than what was in the syllabus.
Okay.
So hopefully, assuming my posting is working, and if it doesn't, let me know and I'll figure out how to post it.
All right. Thank
Well,
you.
the contract is under the announcements for the class.
Okay. Is that work? Or is there a better way to do
We
it?
got an email.
So,
We got an email.
I saw the email in there.
Yeah, we got an email. Yeah.
Modules?
No, come on.
It's in files in mine.
Canvas.
No, but the last thing I have a question for is, are your classes going to line up with the YouTube videos? So like, say for instance, I like to watch the class the day before, so, like say for instance, would your notes line up from last year's?
No, because last year, they were a little out. You can watch them. You want to be bored by me twice. I mean, I don't know why. I tried watching them. I couldn't stand them. So,
yeah, I tried.
I mean, it's, honestly, you're gonna listen to 4 hours of that, 4 hours of this?
Well, I put it on double the time, so
I can give you links to much more interesting YouTube, to the cats playing and things like that. No, again, I tried to make, like for example, if you watch the financing video, you'll go to sleep, because I thought that just going through the loan documents would give a flavor for how loans work, and it's just as dry as reading them. So now you can watch the videos after if you want to rewatch the class, but I can't do any better than that.
Okay.
And again, I'm going to repeat. I don't know if you missed this. If you have the book and you see something in the book that you don't hear me talking about or you don't see on the outline that I'm going to talk about, and you think you want to hear about it, ask me. Let me know. If there's an area I'm not covering, something technical that you see in the book that you want to talk about, ask. I can tell you this: the test questions are not killers. Okay, if you're paying attention, if you're, I'm not going to get super technical on stuff. I also write test questions for real estate certification.
I know.
for the Florida bar.
So I took we watched one class where you said you wrote the questions for the real estate brokers class.
No, not the brokers, the lawyers, real estate lawyers that want to get certified as specialists. I'm not giving those kind of questions. Those kind of questions, you don't want those kind of questions, trust me. I don't want those kind of questions. The first time I did it, you know, you think writing multiple choice questions is not difficult. So I go get on this committee, and I go to the meetings, and I present my questions, and you're supposed to back up your answer with case law, which of course I did with the statute or something. And so one of the other committee persons says, well, why are the other 3 answers wrong? And I said, I made them up. She says, no, you can't do that. You have to be able to explain why each of them is incorrect as compared to the correct answer. And it sounds a little silly, but the reason for it is, if someone is taking that exam and they don't pass, they have appeal rights. And the appeal goes to the next level up committee that is not necessarily made up of real estate specialists, because they are overseeing all the different certification areas of the Florida bar. So you've got to be able to justify to somebody that's not a real estate person why the answers are right or wrong. And sometimes we'll get, because after I finished doing that for a few years, I was on one of those appeals committees, and I will tell you, essays would come across, we'd have to read what people wrote, and these are lawyers who have had a lot of years of experience because there's qualifications to be able to apply for the certification. I can't believe how badly they wrote. You know, what's happened, unfortunately, is it's been a deterioration on the skill of writing. Now it's down to thumbs. Whatever. Sorry, don't let me get old school. All right, so let's talk about what makes a real estate transaction work, and why are there all these blanks in this contract, and do they really mean anything at all? Well, the first thing I'm going to do as an overview is what constitutes a contract. It's an agreement between parties to do something which is supported by consideration. Consideration can be money, it can be mutual promises. And those are the kinds of statements. The consideration can be money or mutual promises. Those are the kinds of statements I will make in class where I will say, maybe that sounds like a phrase you might want to remember. Okay? Because that's something that's a little technical, it's legal, and maybe you might see that kind of a thing on a test. So to say, for example, any contract has to be supported by value. Consideration is value. Value can be green money, it can be a check, it can be a wire transfer, or it can be an agreement to do something, a promise. So legal consideration does not necessarily have to be cash money. If you've ever seen a deed, it says, most deeds say, for $10 and other good and valuable consideration. And it's a recitation in the deed of consideration. Some states actually require you to put the actual dollar amount of the transaction on the face of the deed, and they use that to compute the transfer tax. Florida, for a while, had a Department of Revenue form that you had to file with the deed to show what the transfer tax amount was. They've given up on that. So that's just something to talk about. Yes?
Question. In a real estate class, I learned that love and affection can be considered consideration.
Yes, it's a gift.
For transferring property
That's a
from...
gift.
Right.
We will get to that
That
later
makes
on.
any sense?
What's that? It makes sense.
Yeah.
Why not?
Anything of value.
Yeah, but I thought that it had to be turned into cash. Is that correct or not?
No.
Wait a minute. I'm sorry. You have to.
Do any of you have children?
Yeah.
Do any of you have parents?
Yeah.
Okay. Are you parents allowed to give you something?
Yeah.
Right? Are you giving them something back for it?
Love and affection.
Bingo. So I mean, it's so now maybe there's a situation where I transfer property to you. We're not related. I met you today, and I recite no consideration. Why am I giving it to you? What are you giving back to me? What'd you say? Donation? Is he a charity? No. So where's, and we'll get to this, I'm getting a little far afield though. There's something called donative intent. And we'll get to that later. Let me come back to the outline and the contract. So you can see where we go. You can see how it can go sideways, which is great because the questions come up. But I want to stay a little bit on focus. So you look at the contract, and the first thing you see are the parties. It seems like really, really simple. The buyer could be a human. It could be an entity. It could be a trust. But it's kind of important that it exists. Because if you write a contract, and the contract is in the name of Room 2073 LLC, and you go through the whole thing, and I sign the contract of the buyer's Room 2073 LLC, and I sign my name under it. Do I think that's a good contract? If Room 2073 LLC doesn't exist, you don't have a contracting party. You don't have anybody capable of entering into this contract. And when you get a little bit further down the road, you may have a very unhappy seller. So one of the things you need to do is to make sure that whoever's on that line is in existence. Obviously, this doesn't apply to a human, and it's going to apply less in residential than in commercial. But people have a tendency to write contracts on behalf of an entity that, well, if the contract gets accepted, I'm going to form a company. And that can be a problem. On the other line, the next line down is the seller. And that's almost more important for the buyer to watch out what goes on that seller line than for the seller to watch out what's on the buyer line. Sometimes you can get around the lack of an entity and say that the person signing is signing as trustee on behalf of an entity to be formed, or some nonsense like that to get around it. But when you're talking about the seller, you're the buyer. And again, I'm gonna most of my focus, and you see what it says at the very top of the page, it says commercial contract. Obviously the same considerations would apply for residential, but not nearly as important. So now, I enter into a contract to buy a project, an office building, a shopping center or something, and I'm gonna start spending some money. So I'm gonna start spending on investigations, surveys, loan applications, appraisals, all the things you need to do to get ready to buy a piece of commercial property. If I enter into a contract with John Smith for that shopping center, and John Smith owns a half interest because John Smith and Fred Jones together own the property, and I didn't check that out, and I just entered into a contract with him, I don't have an agreement with his partner. And I can go all the way down the road, and I can have my bank, and I can get to the closing, or it's going to happen when the title comes back. But I could find out that he doesn't have the ownership, and I just wasted my time because I don't have an enforceable. I don't have any contract with the guy next to me, his partner. I can't buy it. What am I buying? So, real easy, you see street addresses, but street addresses are not sufficient to describe property, especially when you're dealing with commercial. The only thing that's really the most enforceable is a legal description. Legal description is what describes the property either by lot and block, meets and bounds, a unit in the case of a condominium. It is a legal way of describing a piece of property. And when we deal with title, we'll talk about the sufficiency of the legal description. But the legal description sufficiency is really, can a surveyor find the property and identify it from what you put in there. The biggest offender, my apologies to those of you that are in the real estate business, my biggest offender in a legal description where we do run into problems is where somebody's trying to get, it's usually a broker trying to get something formed, get a contract done, and they run to the tax bill. And they take the abbreviations from the tax bill. And it's wrong. There's something missing. You find out that they copied half of it. You find out that they don't have a less out for a road that goes through there. That the legal description is, instead of it's lots 1 and 2, it's lot 1 and 2 less the south 50 feet of lot 2. Things like that that you don't see necessarily properly. So that legal description is very important. And these are all things that you need to check when the contract's being put together, if you're being careful, yes.
And this would be, for example, here, it had to be pulled from like BCPA, right? That's the best place to find it is on like the property appraiser side.
If you go to the property, okay, that's the tax bill. So here's the problem. BCPA is a good resource, but BCPA, if you talk to them, they will tell you, I've heard these words myself, they will tell you that the legal description on their card, used to be a card, now it's the computer, is not determinative. What's determinative to them as to what property is identified in that folio is the folio number and the information that's described in their folio. So if they have a digit missing or a call wrong, or they're not lessing out the north 50, or they're not adding in the north 50 feet or something like that, you can't rely on that. But what you can do, this is the resource and I do it all the time, and a safe way to figure out what the legal description is, when you go to that BCPA page, at the bottom of the page is a link to the previous sales. And you click on that link and you get a copy of the last deed. And that's how you find out the correct legal description.
So you're saying that I would assume that a majority of the time it's not an issue, but if there ever was a little mistake, that whichever is put in BCPA, that's a loophole and sale of the property.
It could be, well, it could be worse than a loophole. It could be not a loophole. What could happen could be, you think you're buying this, okay? And you've gone, you looked, this is what it looks like. But what's in the BCPA is missing something, so it's 1 and 2 are in there, and for whatever reason, 3 is not there. It's not showing there. So you write your contract, you take it off that tax bill, the shorthand, and you write lots 1 and 2 of block 2073, and that's your legal description. You think that's good because that's what you saw in BCPA. Because you didn't go to the next step. You're missing lot 3. Now we go to closing, and what are you buying?
1 and 2.
1 and 2. You're screwed because you know what? You don't have your parking lot, you can't run your building.
Can't you just put like on the contract to be filled in by title company?
Nope.
Really?
It's an essential term. And I'm glad you raised that question. Contracts can be created on a napkin, literally. If you have enough information of the buyer and the seller, the price, and identify the property. Now, for that kind of identification, maybe you can get away with using an address and a folio number. A legal description is better for this kind of a contract. But if you have all the essential terms necessary, you can enforce a contract like that. But don't ever put to be determined later, because that's an agreement to agree.
To be filled in by title company.
What are you buying?
Well, because
What are you buying?
You use the folio and address. Because like sometimes the legal description is literally a paragraph.
Attach it. Now, again, if you're filling in a form and you're talking about a small piece of, maybe 3/4 of the time, maybe more, you won't have a problem. But I'm here because I'm trying to teach the right way to do it and how to not have the problem.
So you suggest like taking a screenshot and attaching an image to like if you were to email or scan it to like the title company, actually like take a picture of the title description.
Of the deed. When you go to BCPA and you just say, let's say, see attached exhibit A, and just attach a copy of the prior deed or the piece of the prior deed. That's all. And then you know you're right. So, street address, it's nice, not necessary. A lot of people put the folio number in there just to be safer.
So it's okay to put it alongside the legal description, to add in the folio number alongside that?
It's okay.
I knew that, but
And sometimes if you have all the folio numbers and you're missing part of the legal, the actual type legal, you can get by with that. I mean, understand that these discrepancies will only come into play when someone's trying to not perform the contract in one way or another. If everybody's in agreement and everybody's happy,
it's when something goes wrong.
it's when something goes wrong. I mean, if everybody did what they were supposed to do, I wouldn't have anything to do. Who needs to pay a lawyer to do all this paperwork and go through all these machinations if everybody's going to behave?
I've been in plenty of transactions. Everybody hunky-dunky in the beginning. By the time that closing comes, everybody wants to kill each other.
Well, no, it's not that. I'll tell you where it's more likely. It's more likely when the second guy comes along with a higher price. And all of a sudden the seller wants to get out of the deal. Well, the buyer changes his mind. He's gone past the time where he has to perform, and he's changed his mind. And he comes to me and goes, get me out of this contract. Remember what I said about leases? They're not made of glass, you can't break them. Same with a contract. They're not made of glass either. There's a lot more that could possibly go wrong. Personal property, just what it sounds like. More in a house than in a commercial property, and it's just the stuff that's not part of the real estate. If you're buying a building that has a restaurant in it, and you're expecting the restaurant equipment, you attach a list of the equipment. Because if it's not in the contract, the seller doesn't have to give it to you. Great story, residential transaction, 3 pages of inventory. One of the things in the master bedroom was the bed. Did you know that you can buy a bed in one store and a mattress in a different store? That's it. Did you get that? No. You can buy a bed in one store and a mattress in another store. The 3-page list of inventory did say bed, it didn't say mattress. Day of the closing, they got there, there was a bed, there was nothing on it. Wasn't in the contract. The realtor prepared the contract, had this beautiful list typed up. Guess what? Guess who bought the mattress? I mean,
an antique bed or something like that. If I'm going to be buying, unless it's a hotel or something, keep your bed.
well, but that's practical. I'm talking about describing things.
You're saying that the realtor paid for the mattress.
But they made a mistake.
You make enough money, you give him $300 mattress.
It's there, I don't.
Okay. Next section. Purchase price. Sounds fairly simple. How much and how do you pay for it? So the how much is easy. So we have a deposit. Deposit should be held by somebody relatively neutral. The deposit is the initial consideration for the contract. That's what's put up there to bind. It used to be called a binder deposit, but it's up there as consideration for the contract. It also serves a purpose, as you'll see a little further on, that could be potentially liquidated damages. In a lot of situations in commercial transactions, the buyer has a period of, it's a little further down the contract, but the buyer has a period of time to investigate the property. It's called an inspection period, a due diligence period. There are a couple of different ways to describe it, but it's all the same. And during that period, if they don't like what they see, they can take their money back. They can cancel the contract. You'll see those words in a minute. After that time period passes, in most commercial transactions, the buyer has to put up an additional deposit. Traditionally, once upon a time, deposits were 10% of the purchase price. A lot of times you'll see that in house closings. When you're dealing with multi-million-dollar commercial transactions, it's never that high. The hotel deal I just closed was $20 million. The initial deposit was $250. The additional deposit was another $500. So that's just an example of how it works.
Where's the inspection period on this one?
We'll get there. Financing, if you're going to have a contingency for financing, there's a place to put it back. The E-box is for other. That's where you could have something like almost anything. You could say that could be if there was purchase money financing, like a second mortgage going back to a seller. The Mercedes I'm giving you as part of the consideration because that's what you said you wanted with the house. Anything. It's all kinds of. You put almost anything on there. Sometimes it's used to signify there's an exchange going on. So in addition to the cash I'm giving you a deed to Blackacre over here, all kinds of things. And then the bottom line here is whatever's left. But very careful, you have to see what's here. The purchase price is the balance to close, subject to adjustments and prorations. And then it says to be paid via wire transfer. So not only is it telling you that even though there's a real number on here, it could be subject to change when you read the rest of the contract, but it's also telling you how you're going to pay it. And there's a reason for that because we want good money to change hands. In a custom contract, a type contract, this form is great, and a lot of clients like this form because it's standardized, but in a more sophisticated transaction, they're going to use a typed contract prepared by the lawyers, and we'll put things in there saying the purchase price must be wired no later than 2 p.m. And if it comes in after 2 p.m., the buyer has to pay X, Y, and Z because representing the seller's additional costs. Probably somewhere in here it talks about 5 p.m. Oh, it's the next paragraph. The next paragraph talks about time, the computation of time. whether or not you count, there's business day contracts and there's calendar day contracts. Business days, because when you get into the body of this contract, including the inspection period, it's going to say that you have X number of days to do things, X number of days to get a mortgage, X number of days to do your inspections, X number of days to deliver title, X number of days to close. If you have a contract that specifies business days for all or any of those time periods, it stretches it out dramatically. And on the typed contracts, very often, the buyer will try and get away with sliding that in to see if anybody catches it, because all of a sudden, 3 weeks turns into 4 weeks.
For business days?
By putting in business days. So here, it specifically says, calendar days will be used when computing time periods, except if it's less than 5 days. The other exception is if the time for performance comes on a weekend or a legal, ooh, that's a national legal holiday. That's good. That's important to see, because there are a few state of Florida legal holidays that nobody knows about. And if it doesn't say national, anybody hear of Pascua Florida Day?
What?
Right, it's something in Tampa, but it's in the state statute. There's a statute in the state of Florida, statutes, legal holidays, and that's one of them. I don't know what it means. I don't know what the celebration is. I think it's something with the Pirates, but it's pretty well. Wow. So the other thing in this time paragraph that's important, now I'm going to get into something really basic. It's like the first day of contract law. It's called offer and acceptance. I make you an offer. I will buy your phone for $100. You can do a couple of different things. You can ignore me completely. You can say no. You can say yes, in which case we have a contract, because we have a purchase price and we have a thing. Or you can say, no, I want $150. It's a counter offer. But what I didn't say to you is, I'll buy your phone for $100, and you have 7 minutes to think about it. That's a time limit, and that's what this does. When you have a real estate contract, that's what this blank is all about. When you have a real estate contract and you're submitting an offer to a seller, you want that response back. And if you don't get a response, the offer dies. Now, the offer can die in a bunch of different ways. An offer can be revoked. I didn't hear from you, and before the 7 minutes was up, I said, I changed my mind, I'm withdrawing the offer. Which is okay, because you didn't pay me anything to make the offer, and you haven't accepted the offer. Therefore, there's no enforceability, and I've revoked it, I've taken the offer back. So, an offer can be accepted, an offer can be revoked. Counter offer, you make me a counter offer, it terminates my offer. You cannot turn. Once you've made me a counter offer, I can't turn around now, you can now turn around and accept my first offer. You can terminate the first one. Okay? Offer and acceptance.
Usually they put that in the LOI, right?
Well, the problem with LOIs, this is, when you get to this, you're past the LOI. An LOI is a letter, obviously is a letter of intent. The LOI though, almost every LOI you see has the words, this is not enforceable. This is an expression of business terms to be incorporated into a contract, and it's binding on nobody. Almost every single LOI you see.
Otherwise, usually, like, commercially, since you use proposals.
Well, yes, that's correct, but a real letter of intent, and it's used all the time because, well, this is real easy. This doesn't take a whole lot of time to fill out, right? But when you're dealing with the $20 million hotel deal, you're not using one of these. Well, I mean, some clients will, but for the most part, you're not using this. You're using a contract that's going to take a lawyer 3 hours to prepare. Not really, but that's what they charge for. Oh, God, on tape. So what happens is you use an LOI to get the business terms in front of the other side. Because why waste the time drafting the 50-page contract if you're not agreeing on the price and how long and how much the inspection period and whether or not you're including a liquor license and all those other things. So, but you don't have every term. I mean, an LOI is what, 3 pages? 4 pages? You don't have everything that you have in that 50-page contract. So you put a paragraph in there saying, this is an expression of the business term and the intent of the parties and is not binding upon buyer or seller unless a formal contract for purchase and sale is executed. And anybody that deals with this kind of stuff, you pull out any LOI, that's what you're gonna see. Okay? Closing date and location. Obviously, the when to close is important. The where is always a battle. It should usually be whoever's doing the title work who becomes the closing agent. It used to be, I had a boss early on, his instructions to his paralegals in preparing the contract, he never wanted to leave the office. So he always wanted the closing at our office. So he would get pushback for that every once in a while, but it was a try. Typically, you're going to close in the county where the land is, but believe it or not, all of this is almost fictional, because what happens in today's world is you close where the money is. And most of the time, you don't have everybody sitting together in the same room anymore. It just doesn't happen. The one party signs all of his papers, the other party signs all of their papers, they all get put into the same thing with FedEx, and boom, you're off, you close. I learned something. I hope you should never have this kind of experience, because it's not worth the extra heartbeats that I had to give up. My closing was on Thursday. It had to be on Thursday because it had all kinds of nasty clauses in there. And so the client signed all the loan documents on Wednesday, did everything, got everything right, got the whole package together, put it in the FedEx to go down to the bank so they would fund first thing Thursday morning and get the closing. And I thought the smart thing to do was to check the box that said first in the morning delivery, so that the bank would have it early and they could get everything done to fund it. I get an email at 8:15 from FedEx. We tried to deliver the package at 7:38 this morning and there was nobody there. I'm like, and then it goes on to say it will be redelivered tomorrow after 10. And I'm like, so of course I started making calls and we were going to send a courier to pick up the package. It turns out the driver was good enough to go back at 9:15 and it got delivered. But that was an hour from hell. So, be careful. Don't ever check the first of the morning box. It's not worth it. Okay. Financing contingency. Yes?
So, in a commercial transaction, I have seen that, one party will be in a law office by themselves, filling out docs,
Right.
everywhere, and another one will be in theirs.
Yep.
So how does that, how does that work? You said they get put into the same thing, but what does that mean?
It's a blender.
What do you mean?
It's a machine. You put you just chop all the papers up and with smoothing into it. Let's pull it close. No. What happens is whoever is the closing agent is usually the person issuing title. And the function of the closing agent, and it's often one party's attorney, is they are the ones that are responsible for getting all the documents, getting all the money, recording the documents, and dispersing the money.
Most likely the seller.
No, actually most likely the buyer. Depends what county you're in, but it's most likely the buyer's lawyer.
So, but if
In
you're
Dana Brown,
selling
anyway.
a $20 million hotel, what do you want to have control over that transaction?
Okay, good question. So in this particular case, the seller was a big bad hedge fund. I think it's more than a hedge fund. It's a big national company that has properties all over the place. And this $20 million was a drop in the bucket, or a pimple on their posterior, or however you want to describe it, because they have, multi-billion-dollar properties, hotels and things like that. But this was called what's known as a limited service hotel, and they were selling several of them out of their portfolio because they decided they don't want to be in that business. It's a flagged hotel, but still, they don't want to be in that market. So they mandated in the contract, and they were very rigid in the contract. They mandated that the closing would be conducted by First American Title's national office, which is literally not an agent, it is the title underwriter's closing office, which happened to be in Chicago, which is where the seller's lawyer was. I objected because I make money off of issuing title insurance. So when you pay a title premium, the agent makes a commission. And I said, typically, if my client is paying for the premium, I want to control the title because my client gets a benefit. I charge him less legal fees, I make money off of the title work, everybody's happy. I said, if you insist on picking the closing agent, you pay for the title. They said, okay. They did. So, in this particular case, yes, the sellers all signed their documents in New York. My clients all signed their documents in Fort Lauderdale. My client's bank was in Coral Gables. when everything wound up in Chicago, at First American's office in Chicago, which is kind of stupid because the property was here, and they did everything. Unlike the days where you had to worry about running across the street or down the street to the courthouse to record everything, there's e-recording now. Like there's e-everything else. So you scan the documents, you log on to the software, you push a button, and if it's in Miami, 3 to 7 business days later, you might find out that your documents got recorded. If it's in Broward, it's that day. And that's true. They're
Just don't like doing deals in Miami. It's hectic.
It's, you
You
know,
know, as far as like dealing with the cities, getting lien back, getting title back.
it shouldn't matter. It really shouldn't matter. Anyway, finance. So the answer to your question is that's what the closing agent does, and it could be neutral. It could be a neutral party. But you know, it takes money out of somebody's pocket. So, okay, financing contingency. The financing contingency is very simple. The buyer has a certain number of days to apply for and get a mortgage. And if they don't get a mortgage, they can cancel the contract and get their money back. Easy enough?
What page is that?
That is on the second page of the contract starting on line 45. These contracts are great because they have the line numbers to the left. And I mean, there's lots of verbiage in here in terms of terms and conditions of the financing contingency. But basically, in writing the contract and looking at the contingency, you have to set the parameters. So, if you let's go back to a simple math, and let's say it's a $100,000 transaction. In a $100,000 transaction, you put an 80% financing contingency in there, which is great for residential. You're not going to usually not see that high in commercial, but commercial might be 70, 65, 70, 75% tops. The financing contingency needs to be properly filled in here because if you agree that the financing contingency is 60%, and you get approved for a 62% loan, you've satisfied the contingency, you have to close your deposits at risk. If you don't get the financing, then you can take the money back. So it's whatever the terms are that are set forth in this contingency. Is that clear?
So if you set this like super high, then you're allowing yourself additional.
Amount.
Okay.
Which is most, see, so when you're making your offer, when this is being submitted before it's a contract, the seller's going to look and go, no, I'm not going to sit around and wait for you to get a 95% loan. That's ridiculous. It happens. I mean, there's still FHA financing out there. You can get a 95% loan on a house if you qualify for it. But it's what?
It's like 97, right? It's like
It's 96.5. It's 3.5%.
That's not a loan. That's a temperature. So.
But conventional at one point, this last year, you're doing was right credit score. You could do conventional at 93, 97.
Yeah, but see, here's the problem with that. The problem with that, and this is what happened in the last recession we were just talking about a little while ago. That's great. Now, I'm going to tell you, you would see these transactions, and if you work in the neighborhoods and you work in South Florida, you know what's going on where, and all of a sudden, we'd see a 4-bedroom house, and I'm talking about in like 2005, 2006, and you'd see a 4-bedroom house in West Pembroke Pines for $625,000. And you'd go, something's wrong. And then you'd see a financing contingency for $600,000, which, you know, I don't know the math, but the loan to value is not horrendous in that number, okay? Now, you close the deal, recession hits, or a correction, if you will, and all of a sudden that house is now worth $550,000, which is still too much for that neighborhood, but now it's worth $550,000, but it has a $625,000 loan on it, or whatever my math was. So all of a sudden, it's the expression. Anybody remember what the expression was? It's underwater. That just means that the value of the property is less than the value of the loan, the amount of the loan. And that's bad. And that's what happened. So people said, well, this is dumb. I'm not going to pay this mortgage. And they walked away, and we had a crisis. And by the way, that same loan got packaged and sold in the secondary market, which turned into financing instruments, and somebody got left holding the bag. And the borrowers walked away from it. They didn't care about their credit. Anyway, so you got to be careful. That's the problem with the high loan-to-value ratio, is that if there's a correction in the market value of the property, your equity gets evaporated, and then either you're going to walk away or you're going to be paying for something that's not worth what you're paying for.
But the strategy on this to write the contract when you're doing the finance contingency is, if you know you could get 60 or 70%. Like, say for instance, if you're going to be able to get 60% financing on the ratio, right, so that means $60,000 on $100,000. And you're trying to buy this property at $100,000 and it's commercial. You want to leave your way out. If you write it for 80, the seller might turn around and say, "Hey, no, I don't want that."
That's exactly the point. The financing contingency is there to protect the buyer from a situation where either the credit doesn't work, or, and it's in here somewhere, the appraisal isn't sufficient to support the loan. If you don't get the loan, you get the money back. But you have to watch your days. You have to watch your time, because the contingency is specific. You have to apply within 5 days after the contract effective date, or if it's a longer closing, you can fill in the bank, but I'm going by the default numbers. And you have 45 days to get the loan. And if you don't get it by that time, if you don't come back with a "yes, I've got the loan," the seller has the right under this to cancel the contract. The contingency, either party does. The contingency has not been met, the buyer is not obligated to perform, and the seller is not obligated to keep this contract in effect.
But it's still valid.
It's valid until somebody
Object.
says, "I'm canceling."
Okay, and then what about same with escrow? Like, what if someone says
Yeah,
they're
that's
gonna put
what
escrow and they don't put up escrow deposit, earnest money?
Well, if the escrow was never met, you don't have a contract.
But you can still close on that contract.
Yes, maybe. Okay? You can still close. You can still close. You can always close. Even if somebody's in default, you can waive the default. The problem is, now you have a signed piece of paper floating out there. Okay? You have buyer and seller have signed a piece of paper, buyer's agreed to buy, seller's agreed to sell. Now the seller is actually locked in, and until the seller terminates that contract, the buyer could cure that default at any time. So the seller, even though the seller's annoyed, unless he does something to affirmatively terminate the contract, you have an agreement.
But yeah, so if, say for instance, both parties walk away and escrow was never met, you still have to have a cancellation contract.
Yes.
Signed.
Well, that could be unilateral. That could be unilateral.
Unilateral. But the thing is, with this financial contingency, okay, back in 2017, I know they changed it from being more on the buyer side on financial escrow, and I can see this contract was revised to in 2017, and they did the residential July 2017, because this is a big issue in residential with this part right now. A lot of realtors are missing this, and a lot of them are missing this. The fact that before this law was changed or this was put in the contracts, it was that as soon as the buyer said, "I can't get financing," they could walk away. Now they have to perform certain tasks in the contract.
Okay, so what tasks? Okay, this is a good point of discussion here in the financing contingency. It's not a wide open thing. You can't just say, "Oh, I can't get a mortgage." Tell me, what are the tasks?
You have to basically, first of all, apply for the mortgage in the time frame that you said you were going to.
Correct.
You have to get your commitment from the mortgage in the time frame that you said you were getting the commitment from.
Yeah, but there's stuff in between those two things.
There's stuff that you have to do.
There's stuff in between those two things that are set forth in here that are very important when you're talking about a financing contingency and whether or not a buyer can take advantage of it. You have to make application. You have to provide all kinds of credit information. You have to act in good faith. And you have to comply with the lender's request for information.
Yes.
And, I'm not sure if it's in this form or not, in some situations, the seller, especially if it's a tight deal, the seller can put in a provision that says that the buyer is obligated to provide the seller with reasonable progress reports as to the status of the financing. Also, there is another technique that's used to make the financing contingency more palatable to a seller, and that's what's known as a pre-approval letter. A pre-approval letter is a letter where the banks the buyer goes to his financial institution and gets a letter that says, Mr. Jones has been qualified for a $60,000 mortgage, or a $600,000 mortgage, or a $6 million mortgage, based upon subject to the appraisal. Because you have two elements in a financing contingency, and two elements that drive financing of a piece of property. You have the buyer's ability to pay, and the property's ability to support the loan as in terms of collateral, basically the loan-to-value ratio. So both of those things are contained in here. There is a rider to some of the residential contracts, which is a separate financing, separate appraisal contingency, and you see that sometimes added or even written in where the property has to appraise for the purchase price. Because if you take the situation of a 60% loan-to-value ratio, for example, the contract's $100,000, the financing contingency is for 60, they get the appraisal back and it's at 90,000. That will support the $60,000 loan, but the buyer agreed to pay 100. So if a professional appraiser comes back and says, I think this property is only worth 90, not 100, absent some specific contingency in favor of the buyer, you got to close. You just overpaid by $10,000. Now, again, I'm using numbers that are easier to work with, but remember, in the real world, you're adding multiple zeros behind it. Let me continue.
There was one more question I had about if in the financing, say for instance the buyer did not perform and did meet the and it was denied by the bank at the time to buy the property, and everything was met. Now the deposit or the escrow still has to be released.
You just said something. Be careful how you ask that question. You said the buyer did not perform.
Well, I mean,
if the buyer does not perform, that means the bank said. I'll give you an example. The buyer doesn't perform. This could affect the contingency. The bank said, I need 3 years of your business tax returns in addition to your individual tax returns because you're paying yourself out of your business and we need to see your business. And the buyer says no. Therefore, the buyer has not complied with the requests of the bank in providing the financial information. The buyer has not met the requirements of the contingency, and he's not going to get his deposit back, again, if we get into litigation.
But how about if it's the other way around, the underwriting was denied because...
Then he's going to get it back. If underwriting looks at it and says, no, sorry, you don't qualify, yeah, that's what the contingency is all about. You get your deposit back, and you go your separate ways. Okay, let's keep going. Title. In my world, title is the most important thing that deals with a piece of property. I'm looking at the contract here, and we're going through the contract for the overview of the anatomy of how the transaction works. Later on in another course, the unit will go through specifics of title and what it means and what the quality of it is and why it's important. But here, they're talking about what kind of deed you're going to get. The different kinds of deeds have different warranties and different meanings to it, but there's check marks for that. And what the property is going to be subject to. Now, again, not something you think about unless you're looking to develop, but if the property is subject to a declaration of covenants, for example, and it says that this property can never be used for a liquor store. Why? Because in 1940, somebody was a teetotaler and they felt very strong about it, and you can put whatever, your property, you can put whatever covenant you want on there, okay? And so they put that covenant on there, and it's running with the land, it's a deed covenant, and you know who wants to buy the property today? Walgreens. It's going to be a great deal. Somebody's going to buy and build a Walgreens on this corner, and all of a sudden that covenant pops up. I think Walgreens is going to buy that property? Nope. Because Walgreens has a second door where they make a lot of money with their liquor store. So here, if I am buying this property and that's not in there and disclosed in this provision here around line 77, I don't have to buy it because I find something that was not permissible in there. What is permissible are things like taxes, things that are common to the subdivision, utility easements, zoning. Those are all things that are normal for a piece of property that aren't going to do it. But then if you look at line 78, it goes on to very explicitly say provided there exists no violation and none of them prevents buyers' intended use of the property as, and there's a blank. So if you want it to be a liquor store, you say liquor store. You want it to be a pharmacy, you say pharmacy. You want it to be a dispensary, you say dispensary. That's for another time. Then it goes on to talk about, we don't need to go into heavy detail, who pays for the title and what kind of title. This is really still very antiquated because it still talks about abstracts and things, but in reality, it's...
Really quickly on
Yes.
the line 77 and 79, are you saying that this can get around the covenants or no?
If you disclose the covenant, if you say, for example, you sell the property, you know that that liquor covenant is on there, and you put a provision in there that says, subject to a prohibition against selling alcoholic beverages, and the buyer agrees to it, then the buyer says, yes, this is what I'm agreeing to take, and they can't object to it later. Whatever the covenant is. Or where you're sitting, for example, can only be used for school. It could be that kind of
So
covenant.
what I'm saying is like, for your example, let's just say 1950, there was a covenant in there that they didn't want it to be a liquor store for whatever reason, but you want it to be a liquor store. Is it possible to do that or no? Is there no way to get around the covenant?
I'm going to say no for the time being. Now, that doesn't apply to unenforceable covenants. There are covenants that the courts have held are unenforceable. For example, there's...
Sell to black people.
What's that?
Can I sell to black people?
That's one of them. Except the example that I saw, and my client was Israeli, and the covenant said, no person who having more than 25% Hebrew or Syrian blood. I think that's how it was.
That's illegal. Federal.
It's illegal. It's absolutely illegal. It's still there. You look at the title, you're still going to see the piece of paper, but that's what it said.
So it'll always be on the title no matter what?
Well, because it's in the public records, it's recorded.
Yeah, there's
It's completely unenforceable, and in the title insurance policies, you will find something that says, refers to that deed, and says, but omitting any restriction relating to race, national origin, blah, 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 whatever the other words are.
I've seen something similar to that where a fellow was selling in Lantana had a covenant with the crossing, General Lee crossing the mayor, like they had to honor him, like the HOA had to do something. It was in there, part of the, whatever, with the covenant of the development of property. They don't enforce it anymore, but it's still there, and then they had to acknowledge that they know it was there as part of their deeds.
The problem is, and this is not a constitutional law class, there are classes of people that are protected, or there's types of classifications that are protected, and there's things that aren't. You could theoretically have a no dogs provision, or something like that. Although I will tell you, if there's a no pets covenant in a condominium or something, it won't prevent a service animal. We'll say that for leases.
On line 17, it says, where there exists no violation of the foregoing, it means that...
So let's say there's a covenant. Okay, here. There's covenants that's going to be subject to, but if there's a violation of one of those covenants, or zoning, or building regulations, or anything, the seller has to cure it. That's what that means. So let's say there's a, let's say you get to closing, you get a lien search, and you find out that there's a zoning violation. They trim the trees too much. And the city, they trim the trees.
Oh.
And they trim them improperly. I literally saw this last week. And it was, the city of Weston cited them for tree abuse. Tree abuse, I'm not kidding, that's what it said. Never seen it before, but that's a tree abuse. That's a code violation. And they can fine you. What are you gonna do? Put the branches back? They trim the tree too high. And of course, it can damage a tree, it can kill a tree. It's done the wrong way. There's the opposite of that is called hat racking, which is, it's just plain ugly and it's not good for the tree. You hire the cheap tree trimmer. So they go up and they just cut from the top, and they just cut around. So like the tree that's this big is now this big. That's called hat racking. That's illegal in most cities. What you're supposed to do is go in and thin and prune and do it the right way, which costs 3 times as much because you've got to have more different equipment and training and have an arborist to know what they're cutting and what they're not cutting. So that would be a violation of the zoning or the regulations. A violation of the covenant would be if you disclose that alcoholic beverage covenant and there was a liquor store on the property, that would be a violation. but they're more talking about violations where there's been a citation issued by the city.
You're kind of beating it dead horse here, but just the language, a seller has a legal capacity to convey marketable title to the property, free of liens, easements, encumbrances, et cetera, to the seller. Does that mean if there are any liens, easements, or encumbrances that the seller then can back out, the buyer can back out?
They can object to them.
The buyer can.
The buyer can object to them.
And then, but subject to property tax, but subject to, does that mean?
So,
any
no,
exceptions to?
that means that you can't object to taxes that are for your closing.
Covenants.
You can't object to covenants, restrictions of public utility easements of record. Again, this is generic wording,
Okay. Okay.
okay?
Yeah.
And then what happens is, as you get into as you turn the page, and you get into title examination, that's where the buyer, actually the buyer's lawyer, of course, is going to look at all of these things that are in the public records, and there's time frames that within so many days, they're going to look at it and they're going to write what's called a title objection letter. And they're going to say, I object to this, 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 and this, and this is not super, well, no, this is good. This is actually, this contract is pretty good because it is a commercial contract and it does reflect reality, which is why I have clients that even on larger deals will say use the form because it's fairly complete, and a buyer and a seller, the seller, if you present it to him, he's going to say, yeah, it's standard form, I can live with that, as opposed to a 50-page type form that you're going to wind up spending a week negotiating. So, you raise the defects, and it says around line 98 that the seller may elect not to cure the defect if the seller reasonably believes the defect cannot be cured. Sometimes within a certain time period, and the time periods are secular. The exception to that, I'm sure it's in here, hopefully, maybe not. The typical exception is monetary encumbrances. So the seller can't say, no, I won't pay the mortgage off, or I won't pay the tax lien off. That they can do because it comes out of the purchase price, they don't have to lift a finger, the closing agent pays it off, so they're obligated to cure those title defects. And again, we're going to have a whole discussion on title. This is just contract provisions that govern how the transaction is going to go. Okay? Any more title questions? Property condition. This is where the inspections come in. Because it starts off, most commercial deals are going to say as is, but as is as of the date of the contract. That means if something happens between contract and closing, it's going to, you're going to have to correct it. You're going to have to fix it. For example, something breaks, something major breaks after the date of the contract, the seller does have an obligation between contract and closing to maintain it in the same condition as it was as of the date of the effective date of the contract. But some contracts say, like here, there's a dollar amount. So let's say there was a major storm or something. Here it's at 1.5% of the purchase price. So if it exceeded that, the seller would have the right to say, no, it's too much, I'm not going to sell. I don't want it to be like this. Then negotiate. It usually gets negotiated away. But it does give the seller an option not to spend that kind of money if it's too much money. Now we get to something super important. I have to be careful with this because you can look at 3 different contracts and this is going to be described 3 different ways. This contract, and by the way, they're synonymous, and I don't want this to be this is not intended as a trip up if it comes up on a test question. The due diligence period and the inspection period are the same thing. Different people write it different ways. The due diligence period or the inspection period, here it's a due diligence period, is a time frame. In this case, there's a blank. This does not have a default. This is really negotiated depending upon the kind of property it is and how the parties work it out. It could be 15 days, it could be 30 days, it could be 45 days, it could be 60 days. And during this time period, this provides that the buyer and the buyer's people can have access to the property, investigate whatever they want, can have access to information in most cases if it's investment property to an extent, do physical inspections of the property, and check out everything they want. And if there's anything they don't like, and they don't have to specify it, and it's usually the buyer's sole discretion, and I'm sure the words are in there, I'm not going to point to it, they can cancel the contract and take their deposit back. Now, this has become the norm. One second. Yeah, sole and second line, I'm sorry. The sole and absolute discretion. So the inspection period or the due diligence period gives the buyer the right to make whatever investigations of the property. Oh, that's the other one. So inspection period, due diligence period, investigation period. I knew there were three. There could be others, but those are all interchangeable. They all mean the same thing. They all refer to the same time period. And there's limitations. There's things in here as to what the buyer can do to the property. Some sellers will not let them do a phase 2 environmental inspection. Some transactions, the seller will say you can do a phase 1, but if the phase 1 says you need a phase 2, you can't do it without my permission. And the reason for that is, first of all, phase 2 is invasive. They have to come in and put towers and dig and take samplings and so on. And number 2, if they find something during the phase 2, to a certain extent, it has to be reported to the state. And the seller may not want that to occur. The seller may rather blow the deal than that. So a lot of sellers will say, no, you cannot do a phase 2 without my express consent. And now, where that's not going to fly, that's not going to fly when we're buying a gas station, a marina, a car dealership, and a laundry that is not a drop store. Once upon a time, every dry cleaner on every corner did all the cleaning in the back room. And what did they do with the stuff? Poured it down the drain. They put it out in the backyard, dumped it in salt. Well, that stuff's terrible. Whatever that was, I mean, people didn't care. Same thing with automobile repairs.
That's the EPA lien, right?
Yeah. It's not so much a lien that you're worrying about, it's the contamination.
I mean, they just tie that property up, like it can't be sold to a certain extent.
Well, it depends what. I knew a guy that he bought a car dealership in Baltimore, and it had been a car dealership for years and years, so it went back to the olden days when everybody did everything wrong, and it was contaminated beyond remediation. He ran a taxi cab company there. I guess he bought it right, and that's where he serviced his cars, and he knew that he could never sell this property. I don't know what wound up happening to it, but he knew he could never sell it because it was contaminated. Or he would sell to somebody that could buy a contaminated property and use it for the next thing. Maybe he sold the taxi company and sold the land with it. But, so if it's back then, and as time has gone by, things have been cleaned up. There was a time when you would go by the street corner, you'd see gas stations, and there'd be a giant empty tank sitting on this, on the driveway, because they went through a program. The tanks at one time were made of metal. Metal rusts when it's sitting in moist ground. When it rusts, it leaks. So they would scoop the tank. They'd have to scoop all the dirt around the tank to a certain point, so they tried to get it clean, and they would take the contaminated soil and ship it off somewhere in the deep south, where for whatever reason they created facilities because they could make money doing this and nobody was using the land anyway, and they put piles of stuff there until it somehow cleaned itself naturally. But, so that went on. I had one situation, and I've learned the best part about what I do in representing people in different kinds of properties and transactions is you learn so much about those businesses. So, when you go to a gas station, you ever see a gas station getting gas? The truck that comes, okay? The truck comes, they open up a hatch or a thing, and they take a hose from the truck and they put it into the hatch and they transfer the fuel. Well, believe it or not, that things can go wrong. The hose can break off, the driver might do it poorly, might not tighten it, it can spill. There's actually a contraption, the wrong word really, it's a physical device that is surrounding that hatch in the ground that catches any overspill. so that it doesn't go beyond that. Because, and this is modern stuff, because gas stations were historically terribly polluted and couldn't be sold, and it was very expensive to clean it up. So they come up with that. In a car dealership, what you don't think about is they're washing the cars. When you wash a car, oils, grease, chemicals that are on the outside of the car, that are on the underside of the car, are going to wind their way into the water, and they're going to go where? There's a drain in the middle of the driveway, right? So that was a problem in the old days, because even that little amount of oil and chemical in that runoff would go into the drain and contaminate it. It would get into the soil. Now they have something that's built, it's called a catch basin, by the way, the thing where the water goes in the middle of a parking lot. Now they have an oil and water separator device that's built in there, so that it literally separates the oil and lets the water flow down where it's supposed to go and keeps it clean. Yes?
So real quick, could you just explain again like the phase 1, the phase 2, and like basically the legality on each phase?
Sure. So phase 1 investigation is basically a study of what the property is being used for. It's a paper study. It's a study of what the property is being used for now and what it has been used for in the past.
And real quick, what are the purposes of the phases? Are just for the buyers during the due diligence period, or is this?
It's to determine if there's an environmental problem with the property. So in the phase 1, they will go back and look at historical photographs, air photographs. And I don't know if you play on the Broward County Property Appraiser's website, there's a place where you can actually look at aerial photographs of the property going back, I don't know how many years, maybe 20, maybe 30 years, and see pictures of what it looked like. So they can see whether that piece of property has been used for a gas station, a service, or maybe it was just fields. Maybe it was nothing. So they can determine, based upon what they're seeing in the current use and the historical use, maybe it was a dry cleaner. Maybe it was a dry cleaner before they were just drop stores. And based upon what they find out, they will say, okay, we think this property has potential to have a problem based upon its historical use, and therefore we are going to recommend further investigation. Further investigation means phase 2. Further investigation means dig into the ground, take a sampling, test the soil, and see if there's oil or poly, whatever it is that comes out of the dry cleaner, and see what the problem is. But it's invasive, and if you find something, it's reportable.
And as a lawyer, you're doing all these things?
As a lawyer, I'm coordinating, I'm doing testing.
Well, the bank requires
The banks are, well, yes, the bank is.
if you have cash, you don't have to.
You don't have to, so you can make the decision to buy the contaminated property. You can also run into a problem where you're buying a piece of property. I had one in West Palm, and the dry cleaner was 3 blocks away, but it went down, went into the water, the groundwater, and was traveling. Now, eventually, some of those solvents will leach, and they'll go down naturally, and they'll dissipate to a point where there's not a problem. The problem comes up a lot where it's a neighboring property that's committed some offense. And it's the neighboring property that's spilled, released, whatever, and it contaminates your property. You have no control over it.
So during the due diligence period, typically, especially if you're getting a loan for it, you're going to be required to do this is just something that always goes with a commercial sale of the property.
Yes.
Gotcha.
What happens when a land, for instance, across the street from my office, there's a gas station that was tore down.
Is it what?
A gas station that was
Okay.
tore down. This gas station, I know, was there from years ago because my dad owned the property next to it when I was a kid. So I remember there was a gas station there, whatever. So I noticed that they put it up for sale, but every time somebody looks like it goes under contract, I can see it from the window of my office, and they'll come do some testing and then the contract sign will come off. Recently, I noticed that they put this fence around there and they have this machine in the ground, like that at night on Friday nights for some reason, working late night, it makes all this noise and rumbles my building. So is that what they're trying to decontaminate the land so they can sell it? Is that a
I
possibility?
think it's more of a monitoring well. They can't decontaminate it with that machine, but it's a monitoring situation to see what's going on down below. The only really way to decontaminate a gas station site is to scoop it all, is to scoop the dirt out, scoop the old tanks out, and get rid of it and put clean soil in. It's done all the time.
Okay.
And it's not just gas stations. It could be a
one of the most polluted lands are golf
Anything
courses.
involving chemicals and that type of stuff.
Well, it's funny because the one that I thought, and I was at a seminar, and they were talking about this very issue and different types of property. And the stuff that you think of as problematic, car dealership, gas station, dry cleaner, factory, things like that. And the expert was talking about cow pasture in Central Florida. And I'm like, cow pasture? Well, what's the problem with the cow pasture? I mean, it says grass and the cows are eating it. Well, what happened was, back in the, I'm going to say 30s and 40s, what they would do is they would dig a pit in the fields where they had cattle, and they would fill the pit with gasoline and arsenic, and they would walk the cows through this chemical to kill the bugs. And when they were done, what happened to the gasoline and arsenic? It went into the ground. So there had to be, development land, even out west, what used to be out west here was all agricultural. I mean, when I first moved to Broward County, what you see now is the Broward Mall, that was all cow pastures. And then all of a sudden, when they were starting to get ready to develop it, there were cow pastures with cows with fire hydrants. Because that's what you do, is you start the development, but you leave the animals there because you still have an agricultural exemption, which keeps your taxes down until you're ready to build. But, so who knows what was there originally?
Are you familiar with the Walmart in Hollywood? They were in Hollywood.
Which one? Where?
And that was, it was the mall for a long time, and
At Hollywood Boulevard and 441?
yeah,
Sure.
and it was like
It was a big mall. So you know what the Pembroke Lakes Mall is? So if you imagine taking the Pembroke Lakes Mall and all the anchor stores that were there and put them at the corner of Hollywood Boulevard and 441, that's where they were. There was, pardon my dating myself, but it was Bernard's, Sears, Jordan Marsh, and Richards. Yeah, but most of you won't know those names.
I know Bird Eyes. I used to shop at Bird. I always think.
So, sir.
How does brownfields fit into all of this? Because, before I came into real estate, I was a construction engineer, and I worked for companies. I remember one of the projects I worked on was a sewage treatment plant, 90 million gallons of sewage I looked at every day. And they were building stuff.
That's a crappy job.
Say that again?
So that's a crappy job.
Yeah, loved it, but that success, as the supervisor called it, turned me off. Anyway, they came in and they dug up everything, and who knows what is there now? Maybe shopping center, school, whatever. So how does the EPA has called these brownfields and stuff we're talking about?
Well, okay, so there, the brownfields were, we don't have it as much here as up north where there's big manufacturing. It's a large area of property that was contaminated.
Right.
They can be remediated over time, but it's very, very expensive. If you're in a neighborhood or an area of town where the land is worth that much money, then you're going to spend that money. Similarly, when you're talking about development, anybody know what muck is?
Muck?
Muck.
They have that in Belgrade.
No.
No, muck is the grease and it's all that mixture.
It's wet soil.
It's wet soil. So basically, what happens is when you go to, it's soft dirt. It's wet, soft dirt. Mud, effectively, but it's not necessarily mud. It can be dry as well, but it's soil. So what happens is when you go to build a housing subdivision in Davie, and you've got your cow pasture, or it used to be an orange grove or something like that, if you tried to build something on the muck, it would sink. Or it would sink partially, which is not very good for foundations and things.
That's why I gotta pack it.
Well, before you pack it, you have to demuck it.
Isn't that what they do in Weston? They
Yes.
dig and then they fill it with concrete?
Without concrete.
They dig it,
Stone, rock.
they dig it up, and then they fill it with sand, and they kind of flat.
But if you clean the muck, you can use it for landscaping berms. There's function because it's soil, it's fertile soil, it's good stuff for growing plants, but it's not good things for building.
All right.
So in some places where it's too deep, or if you don't have a solid base down below, that's when you have to use pilings. You may have not seen projects like that where they actually will determine the foundation parameters, and they bang concrete into the ground to make support to put the building on. So you go into a place like New York City, and you dig down and it's bedrock. So you can put big buildings on it. In fact, if you look at Manhattan, you'll see that some parts of Manhattan have giant high rises and some parts don't, because there's some parts of the island that have the bedrock close enough where you can use it to support the buildings, and some it's too soft and it won't handle the 70-story office building or hotel. So muck is what is scooped out.
My question was if you were familiar with that mold issue that was at that mall, why it just sat there forever.
I think it was just mold. Mold occurs everywhere. I mean, people freaked out about mold. Let's face it, we live in a damp environment. You're going to have mold. If it's not taken care of properly, if you let something fester, yes, it's going to turn into something that can cause problems. It doesn't mean it's the end of the world. It can be removed sometimes. So our walls are made of paper. It's drywall. It's squished layers of paper. If you get that wet, like you have a flood from, oh, look, a hole. So, great example. You have a flood that comes down and it gets the wall wet because typically the pipes are in the wall. So the pipe breaks upstairs. Actually, we just had this happen this week in our New York office. The pipe inside the wall burst and it caused a flood in our office and it problem the 2 floors below. But it's the building's issue, not our issue, except that we have a wet kitchen. So this gets wet if it's not properly taken care of. Moisture is a place for organisms to grow. The organisms are everywhere, but you see them and they get disgusted. We had a problem in where I live, our condo. There was it wasn't a flood. It was corrected by an insurance person. It was an accidental discharge of water from an appliance. It's a technical term, the flood. He explained it to me. Flood is rising water. Floods when the river overflows, when the canal overflows. When your pipe bursts, or in my case it was a water filter that broke, it was an accidental discharge of water from an appliance. Anyway, we came back from dinner one night, there was 2 inches of water in the living room. We had wood floors. Well, there went the wood floors. And it also affected, so if it hits the wall, you ever take a piece of paper and get it wet? It's gonna go up the paper, right? So with this drywall, if it gets wet down there, it's like a sponge. It's going to suck up the water. So what happened was they had to knock out, first of all, we had to replace the floor. In a condominium building, underneath your flooring, you have cork or some other underlayment so that you don't hear the pitter-patter of feet from, I think it was Paul Simon said, one man's ceiling is another man's floor, which is true. So you have to have an underlayment by code and by the building regulations. In those days, the underlayment was cork. Cork also absorbed the water. By the time the tile arrived to replace the floor, that my wife ordered from the slowest quarry in all the world, when the contractor lifted the wood up from the floor and lifted the cork, he freaked out because there were 2 little black circles on the concrete. And it sat wet for so many weeks and my contractor was a germaphobe. So he freaked out and we had to stay an extra week of treating it and then letting it sit and then retreating it with something else. And then we were able to go to the next step. But so sure, mold can be easily taken care of. It's a problem because it can cause health issues. If a property is left to sit vacant for an extended period of time, it can be everywhere. Anybody remember the Chinese drywall problem?
Yeah.
The problem was that you had whatever the materials were that you used to make drywall. I don't remember what the mineral is. Is that a mineral?
The gypsum would come from something else. What it comes from, I'm not sure.
So what it came from was next to a sulfur mine, and they got mixed. So there was sulfur in the drywall, in the component of the materials that made it. You put it on the wall, and after a while, the sulfur started to rot the copper pipes, the copper wires in the houses. And so builders didn't know. They ordered a truckload of drywall. The drywall came. They screwed it into the studs that were there and delivered the house. And all of a sudden, they had a problem. They had lawsuits. So all of these things come under inspections and inspection periods.
I've heard, this is, I don't know if it was, I never looked into it, but because of the and you said there's other issues, but because of the mold, it seemed like it became an environmental issue because no one had the money to clean out the mold
That's all
because
it
it
is.
the
It's all
air
money.
or something like that.
It's all money. Because what happens is, so again, you take a situation where you leave it alone, and now it spreads. Mold, spores, airborne stuff, it gets up into the ventilation systems, and now your ventilation systems have to be replaced and they're compromised. I don't know, did they tear the whole thing? I haven't been by there. They tore the whole thing down and replaced it with the Walmart?
Walmart bought that whole block or whatever.
And?
They completely rebuilt it.
So they tore it to the ground.
But
Sometimes,
only Walmart
believe it or
can
not,
do that.
sometimes that's cheap.
No one else has that kind of cash. That's what it seemed like.
Well,
One had the cash.
Walmart bought a property on Oakland Park Boulevard.
Oh, the Kmart.
The Kmart.
Yeah. I
And
was thinking that.
they
I don't know what they're doing with that.
reselling it. For whatever reason, they decided not to build.
No, man. Been
Happens.
begging for a long time.
Yeah, well, that's a problem.
I live on
Oakland and what?
6th,
near
East,
near Dixie.
East
Oakland,
6th.
Dixie. Between Dixie and Andrews.
Right.
Hold on. As I said over here, where are we talking about?
It's a Kmart. It's a Kmart, Oakland, Northeast 6th. It's actually right at Northeast 6th.
Yeah, you're right.
Because I take that as a shortcut up from,
Yeah, you're right.
coming up from the
That goes
office.
right to Walton.
Exactly. Okay. Continuing on through the contract a little bit. We'll probably make more speed through it now because it's less controversial stuff. Seller's got to continue to maintain the property and operate the property. So let's say you have 60 days between contract and closing. The seller can't just like walk away and let the place rot and let things break and let tenants leave and things like that because the buyer bought something in the condition that it was as of the time he agreed to buy it.
Hold on,
I am on line 152. And then, there is another provision in here that restricts the seller's ability to enter into new leases. Because now, again, commercial property, rental property, the seller's been operating the property, the buyer's expected to come in and close based upon what he's seen, and maybe there's 3,000 square feet that's empty, a little shopping center. Now the buyer's intention is, the seller's been so lazy. He hasn't fixed this place up, and he's getting $18 a foot for the rent. Now, I can do $25 without even lifting a finger. Now, as soon as I close, I'm going to rent these 2 bays, and I'm going to paint the place, I'm going to make it better, and I'm going to value add. This provision says, if there's 2 check boxes here, and it's a negotiated thing as to whether the seller is allowed to enter into a lease, because now the seller's still the owner until we have a closing. So should the seller be allowed to put somebody into one of those bays, or should he have to go to the buyer and ask? Well, it's here in this form, it's only a yes or a no. Ask or don't ask. In most negotiations where there's long time periods, if the buyer is still in the due diligence period, the seller can do whatever he wants. Because the seller doesn't know the buyer is going to close. He's not obligated to close. He can back out at any time, number one. And number two, if the buyer is unhappy with what the seller's done, let's say he puts in another $18 a foot lease, the buyer is in his diligence, he can cancel. And by the way, one of the things I forgot to mention in the due diligence period, to simplify contracts and to simplify negotiations in a lot of situations, the buyer will not put in a financing contingency, even though he's absolutely going to get a mortgage to close. And the reason for that is he knows he has that 45 days due diligence period, during which time he can cancel anytime he wants to. And so, instead of complicating the negotiation back and forth with a financing contingency and an inspection contingency, the buyer says, I'm going to buy the property for cash, as far as you know, I'm not giving you a mortgage, but if I get a mortgage, it's my problem, not yours, and I'll make my decision during the due diligence period. The next section is section 9. I don't want to go into huge amounts of detail, but it governs the closing procedure itself, not the when, but things like possession, who pays what expenses, what documents get passed from seller to buyer, what's required, proration costs, rent, taxes, expenses of the property, what happens with any special assessments passed by a taxing authority, and then there's that FERPTA clause. Remember I mentioned the Foreign Investment and Real Property Tax Act is a provision for an affidavit here. So if the seller provides it, then fine. If not, then the buyer's going to withhold it. It's a disclosure. Section 10 defines the duties of the escrow agent. That's the person holding the deposit. Sometimes it's the real estate company. Sometimes it's the escrow agent is somebody's lawyer. Sometimes it's whoever the title company is that's going to close it. Cure period. This is a nice little provision that's been added in the more recent years of the contract, and basically says that before I can default you and make a claim on your deposit, I have to give you written notice of what you've done wrong, and give you 5 days to fix it. So this is very important because talking about defaults, you have certain rights, or defaults if you prefer, you have certain rights in what you can do, but before you can allege that the contract is over, give me a notice so I can fix it. The only exception, if you look at the end of the paragraph on line 218, is you don't get notice and an opportunity to cure if you don't show up for closing. It says it doesn't apply to failure to close. Very often, again, writing a custom contract versus using a form, I'll also put in a provision that says failure to make the additional deposit when the inspection period is up can also be deemed a default. Give the seller the right to cancel. If you don't put the money up, then you shouldn't have any rights. Force majeure. Anybody heard those words before?
Yep.
So this is an excuse of performance for things that are beyond your control. I'm not going to go into great detail, but if you look at line 222, you'll see a definition of a whole bunch of things, going about 3 lines of things that you just can't prevent. Obviously, if you're entitled to the deposit back, you get the deposit back. I'm not quite sure the way that's there. Default. Okay. So there's default is a failure to perform.